Hey, what's
Boom!
up, everyone? Hard money.
Grizzle hard money. This is the year of hard money. Guys, thank you for joining us. We got a jam-packed show. Scott, let's go.
So you know how we do it. If this is your first time tuning in, Hard Money 2025, we bring together some really smart strategists, portfolio managers, and the guys on the ground digging out the gold, the silver, not the Bitcoin though, but they're mining the Bitcoin. So we're gonna have a great lineup. Stay tuned. This is Hard Money. Man, love that intro.
Yeah.
Can't get enough of that intro.
All right. Guys, we got a jam-packed day. Thank you so much for joining us. We're here live all the time. Listen, and if you are around, give that a little retweet. Give it a little love. Share.
I need some hearts, please. I need to be resuscitated. This is a marathon, so we need your help to keep going. Remember, this is a live show. If you have any questions for any of the guests, any of the topics, just put it in the chat, and there's a chance we might ask it. All right, so do you want to introduce our first guest?
All right, listen, we're kicking it off with the one, the only shy girl, Tracy Shuchart. Go bring her up. Let's go.
Tracy, welcome to Hard Money. Great to see you.
Morning, guys.
Great to have you here. A regular for our hard money commodity one-on-ones. Tracy, thank you so much for joining us. And it's a pleasure to have you kick it off this year.
Always. Thank you, guys.
Well, we haven't unveiled today as well. A big announcement. Everyone, Grizzle and Hilltower, myself, Scott, Tracy, we are going to be hosting a brand new out-of-the-box show on X Spaces. It is a pay dirt compass. It's where you're gonna find the greatest next mines. It's gonna be phenomenal. We're gonna be hunting for gold, for silver, for polymetallics, for copper, for nickel. So we're gonna be looking for all the mines across the world. Tracy, it's gonna be a phenomenal show.
It's gonna be exciting. I'm very looking forward to it. We're gonna all learn a lot. It's gonna be great.
It's going to be great. And the idea is basically we're going to have a map and we're going to put pins and show you the companies where they're operating. We're going to ask them hard questions. We're going to say, hey, listen, how are you not going to dilute us away? Why is this, give us certainty this mine is going to come into production, but we're going to give you the information to really build what you give you the information for your investment thesis, and it's going to be exciting. The time couldn't have been better because we're sitting at this incredible inflection point. Tracy, we've talked about it at length. Scott and I talk about it nearly daily. It's the fact that there's a disconnect right now between gold and the gold miners, right? And we're seeing it across all commodities. The price of the commodity,
silver miners, whatever you look at,
and the underlying stocks, and that is it's a great opportunity. The price of gold is the price of gold, but the price of gold miners, the stocks, are baking in an underlying gold price, and that gold price is a lot lower than what the market is. And it's a very exciting time. So we're gonna map the whole continent, many continents, Tracy, many
continents. Several.
Trace, how are you? And maybe we can just let's start with gold, right? I think we have a great chart to bring up just to kind of lay it out. You tweeted this out this morning. This is how we roll at Hard Money. Information comes live, we bring it right on the screen. So, Trace, this is a great chart. Gold is the second largest component of global central bank reserves. This is kind of
it's a huge deal.
It's a huge deal. What's old is new is all I thought we were the world had us that we didn't need gold anymore. And surprise, surprise, in 2025, gold is the second largest reserve currency, effectively, right? You got US dollar 46% of central banks, gold at 20, and the euro at 16, and a hodgepodge making up the remainder of 18%. Tracy, what do you make of all this and gold's time?
Well, obviously, I think this market is very different now. It's being more fundamentally driven than it used to be. It was kind of just a paper market. And now you're seeing central banks buying, and they are buying at any price. They don't care. If they want to buy, they're going to buy it. So I think we're going to see a lot more of that happening. We've had the 11th month of inflows for central banks, which is huge. And so the demand is there. And of course, with that demand comes higher prices. And with higher prices comes, well, more demand, right?
Yeah. 100%. Yes, so you're basically thinking we can count on central banks to be buyers of gold going forward. They're not going to just stop at this point.
No, they don't care what price. If they want to buy it, they're not looking at the price, as we've seen, right? We've seen increased buying as the price of gold's broken out in actuality, right? And the big surge really came right after the Ukraine invasion, right, in 2022. That's when we really started to see central banks ramp up purchases. I mean, they have over the last 10 years, but that's when we really saw sort of this push by central banks in gold buying.
Yeah, I mean, we're already 3 years into that, right? And it hasn't slowed down. If anything, it's picked up. So I think that's just a good indicator of what's to come.
And Trace, like, one thing, I know we've talked about it, but this bipolar world, right? Like in a world that is increasingly becoming more fractured, gold becomes more important in that mix, right?
Well, absolutely. Of course,
it's a differentiated thing. Now, Trace, I want to get your thoughts just on, obviously we've got a great show coming up. I highly recommend everyone stay tuned, and Pater Compass is where the next gems are going to be unearthed, but we had to give it context. Let's talk about the GDX. And don't get me started. I got issues with that GDX, but it's the bellwether. Right. It is what it is. But why don't we talk about the GDX and, in relation to gold, and, these miners' relation to gold.
Right. So, let's talk a little about, year-to-date return performance for gold's 18%. If you look at something like GDX, and if you don't like that basket, a lot of them all.
I don't like that basket, Tracy.
look the same. You're looking at like 52 to 55% year-to-date returns. If you look at individual companies, say one like Newmont, that's at 44% year-to-date returns. And so I think really what you need to understand is, why are gold mining stocks outperforming gold in 2025? And I think there are a few reasons here. One is operational leverage. The primary driver behind mining stocks' outperformance is operational leverage. So that's the amplified impact that rising gold prices have on a mining company's profitability. And so obviously when gold prices increase, mining companies benefit disproportionately because their production costs have remained relatively fixed while revenues surge. If we look at, all-in sustaining costs, AISC, most major miners still operate between $1,200 and $1,600 per ounce. And obviously we're trading north of, $3,200, $3,300 right now. The second reason is margin acceleration and cost management. So despite inflationary pressures affecting the mining industry, companies have demonstrated remarkable cost discipline in 2025, which is something new because we haven't always seen that, right? They were kind of like oil companies back in the day, right? Yeah. They didn't really care. So again, that is really important. So, their production costs have moderately increased, only about 7 to 8% per year, which, gold prices vastly outpaced that growth.
And Tracy, what's another interesting point is that on that cost containment, you have typically in inflationary times, you'll have gold and oil move in tandem. So, oil becomes a headwind for that margin. But like now you have, oil at a relative low. So you also have that tailwind of low energy prices into the mix, which is a great setup as well.
Right. Exactly. And so the third reasons we've had production growth and operational efficiencies. Mining companies have successfully increased production while maintaining cost discipline. We also have obviously market dynamics and investor sentiment. Again, I talk about we've got central banks buying, we've got geopolitical tensions going on, we've got supply constraints. We've got JP Morgan forecast a 500-ton supply deficit in 2025. And of course, we have a little bit of that is dollar weakness also. It was kind of helping propel that market. And so I think, if we look at kind of financial performance going forward, I think the combination of higher gold prices and operational efficiency is, has not only resulted in exceptional finance metrics right now, but if we look at, what some of the gold price forecasts are, we're looking at, depending on the bank, but north of 4,000. Right. And so if you had, say, for example, 4,100 gold per ounce gold, mining stocks could see an EBITDA expanded by 40 to 50%. And so I think a lot of people are thinking they may have missed this rally, but I think that there is so much more potential in mining stocks.
Yeah, we're going to have some good guests on to talk macro to see why, this still could be early days for hard money, mining stocks, gold, silver, you name it.
Yeah, but totally in agreement. We're this is 1 year of outperformance, right? And the one complaint, right, has been how gold has been on obviously a structural bull market, but when you look at the underlying equities, they've just lagged for so long, and now you're getting this catch-up trade that we're 1 year into this for the reasons you've just stated. It's a fascinating time. Now, Trace, I'd be amiss if we didn't talk about silver, because that has been your Trace has always been our go-to silver expert.
She was pounding the table last hard money, and look where we are.
Pounding the table. Trace, give us the update on the thesis in silver, where we stand. Is parabolic still out? Is it still ahead of us here to talk us through the thesis?
Right. So, we still have bullish drivers. We still have industrial demand surge, especially from green tech. And even though green tech is not very popular in the United States, it is elsewhere, particularly in Asia. So you've got solar PV demand, you've got EVs, you've got electronics, you've got AI, electrification, right? They're building out data centers. You have semiconductor expansion globally to meet those needs. We have a tight physical market and a structural supply deficit. Our deficit is 150 to 250 million ounces in 2025 if demand projections hold, right? We've got supply growth kind of constrained by aging mines in Mexico and Peru. We've got lack of major new projects coming online, and you've got high grade depletion and permitting delays on top of that. So again, tight market, structural supply deficit. We've got monetary tailwinds, and kind of like defiatization. Can I call it that word? Kind of what we mentioned with central banks buying, right? And so along with that, we've seen central banks and other people expanding into other assets, other hard money, right? So that also helps. We also have retail and ETF demand, right? And so I think that really, again, there is a historical kind of catch up potential also for silver if you look at the silver gold ratio, right, which traditionally is around 60 to 70. We've seen 85 plus for a very long time. Now, silver tends to spike higher and with more potency than gold does when it finally does catch up to that gold rally. So I think we're not even in the tiny beginning stages of this rally, to be honest.
Interesting.
It's yeah, like we're silver is that classic coiled vehicle. It's a coiled setup, and it's a very exciting place. And well, Trace, want to thank you first for kicking off Grizzle Hard Money. Second, for those where can people find your good work? I see Ninja Trader in the background.
I'm in the Ninja Trader.
You're being whisked from Studio A to Studio B to Studio C.
We're lucky we got you for a minute.
Yeah, so we got Ninja Trader. Mic drop Wednesdays, right? Mic drop Wednesdays, a regular, right. And soon to be added to the mix, Pay Dirt Compass, right. The greatest place you can find the greatest minds on earth.
So, but every morning, just want to say I'm on Ninja Trader Live on the Ninja Trader YouTube channel at 8 a.m. to talk macro markets, and then I'm back at 2:30 to talk commodities.
Amazing. And that show, the Ninja, like it's a great setup you guys do every day. It's really like, I'm like, like who needs CNBC anymore? Who needs that?
I'm saying, right?
Right. Trace, thank you so much. As always, a pleasure to have you join us. That's Tracy Shuchart. That's Hard Money, Hilltower Research. Thank you very much.
Thanks, Tracy.
Thank you.
All right, everyone. Hard Money, we're just getting started. We have a great guest talking about Bitcoin, one of the smartest analysts from Bloomberg. You've probably seen him before. He has all the insights on Bitcoin and hard money. So we're going to bring him up in just a minute. Don't go anywhere.
Stay tuned.
All right, we're back. Hard Money, next guest. Why don't you tee it up, Tom?
You know what? A dear friend of the Grizzle Hard Money Conference, and I want to say one of the most accurate shot callers in the game.
Let's
this was
go.
Good. Like James came out, called the biggest trend in Bitcoin, which was the ETF proliferation, right? And James Seyffart from Bloomberg. Let's bring him up.
James, welcome back to Hard Money, man. Great to see you, brother.
What's going on, guys? How are you doing?
What's going on, man? They had the hardest working man in ETFs right here, man.
That's right.
You know what?
I don't know that.
You had this tweet that actually totally got me. You know that day that everything was like going into turmoil with Musk and Trump? You're like, this right into my veins. This was the original Twitter. I'm like, oh my God, that was totally it. I was like, that was it. I was like, why am I so happy today? And I'm like, your tweet came. I'm like, that's exactly why. I love this chaos. I'm like, this is the presidency. This is the richest man on earth. Where else can we find this nonsense?
Right.
Yeah, unbelievable. It's just too good to be true.
Too good to be true, man. James, thank you so much for joining us, as always.
Yeah, no, I don't want to waste any time, James, because you have a lot of insights I want to pick your brain on. First, I just wanted to start on the influence that Bitcoin ETFs can have on the price of Bitcoin. I mean, we saw it last year. You guys were all over that. Now, I'm wondering, do you believe that ETF flows will continue to be the most important indicator to watch when forecasting where Bitcoin will go? Or are there other things going on that we should be aware of as well?
Yeah, I mean, I don't think they're the number one indicator, right? Period. Stops. But they are like they tend to like the ETF flows tend to follow like a bunch of other things that are happening, right? So they're not necessarily the tail wagging the dog, though in some cases they definitely can be. A lot of the money coming in so thus far has been institutional, most recently, but most of it is still retail. So, I mean, the things I'm watching are more like the stuff that everyone in Bitcoin is watching, right? They're watching the governments coming on board. I mean, the number one topic right now is the Bitcoin treasury companies. Like that's where all the demand is coming in. But people aren't really paying attention. I mean, the Bitcoin ETFs have taken in over 9 billion in the last 7 weeks. I mean, that is insane. So
Yeah.
the numbers are really the numbers are going off, and a lot of it has to do. You talk to some of these people running these ETFs and the people that are investing in these things. They got a lot of calls when there was that, a bit of a decoupling from risk assets that Bitcoin did a few months ago when we had this massive sell-off. People were like, Bitcoin should be way down. It should be down even more than this. Like, this is crazy. And people started really taking notice. And we think that's where a lot of the money has come into the Bitcoin ETFs. That said, I still think there's going to be a lot of demand. The biggest new demand driver for Bitcoin ETFs is likely going to be the advisor community. But yeah, it's they're just like a piece of the pie. I don't think they're the tail wagging the dog. I think they're following overarching trends of what's going on in spot markets and other crypto exchanges, but there's certainly a big piece of the pie now.
So maybe on that point, James, I'm just kind of, you're closer to the ground in terms of allocation from advisors. It was my understanding that, there was a large amount of the Bitcoin AUM was advisor money, but could you maybe give us more of a background on do you guys have a good profile of who are in these ETFs?
Yeah, we actually do. So if you look at, well, one, if you have a terminal, you can see this. I actually did a note that's literally called like who owns the Bitcoin ETFs.
Okay, nice.
I knew you were the right man to talk to.
This is why you get a Bloomberg subscription. We are subscribers.
Yeah. This is an advertisement for the Bloomberg terminal. I mean, we looked at the 13F data, which is like how you can see who owns what, usually public equities, but the ETFs fall into that reporting requirement. In the end of December, the biggest holders were hedge funds. And a lot of that had to do with the basis trade, right? You're going long the ETF for the spot leg of that trade. So you're going long Bitcoin directly, and then you're selling the futures that are due in a month or 2 months, and you're earning that spread because they have to they'll meet up at a place. It's almost like an arbitrage basis trade. There's a yield there, and the yield was very strong from like end of November through like early January. We're talking double digits, getting up to like 15 plus percentage points, depending on what you were doing. That kind of collapsed into February. That was part of the reason we had massive outflows towards the end of the first quarter. Obviously, there was risk assets selling off as well, but a lot of the money coming back in hasn't been that basis trade. And what we saw as of the end of Q1 reporting, which we don't get until the middle of May, so it's relatively recent data, advisors actually jumped hedge funds as the biggest holders. So yeah, this is a trend that we're going to see continuing to go forward. It's going to be advisors that are going to be the driving force behind the demand and flows probably over the foreseeable future. Obviously, traders are going to be a big part of it, but we only know 23% of the holders, which means the other 77-ish% as of March 31 are either retail, people that don't have to file 13Fs, or there could be international companies or holders and institutions that along those lines that aren't required to file a 13F. But yeah, basically this is becoming more going down the advisor rabbit hole. And I think that's where most of the demand is going to come from, because as these platforms, wirehouses, wealth platforms basically give the green light for investors or for advisors to recommend this to their clients. That's really not the case just yet for the vast majority of where these trillions of dollars of wealth are stored.
That's fascinating because, I would have intuitively thought it would have been, a much larger slug advisors, but it's suggesting that like
early days,
like you're like that 77% is, not non-filers effectively, right?
Correct. Yeah, it's a lot of retail. I mean, if you looked at anything from when these things launched, everyone was like, this is retail, advisors aren't buying it. And a lot of people thought that was like a bad thing. But like that's the way all advisor platforms and wirehouses think. UBS, Merrill Lynch, Morgan Stanley, Raymond James, like just because an ETF is launched, if you're an advisor using that platform, it doesn't mean you can just buy it for your client. Like there are rules and restrictions. At least here in the US, it's pretty much how it works globally. And there's like 3 different tiers. The first tier that you don't ever want to be on is like you can't buy under any circumstances. Some platforms still have Bitcoin ETFs on that thing, including Vanguard, which is a retail side of things, which we don't have to go into if we don't want to. But then there's a middle level where like if you're my advisor and I come to you and I say I want to buy the Bitcoin ETF, they can then do it for you because I requested. That's unsolicited. You're not trying to sell it to me, but I'm like, I want it. And then, or some other requirements need to be met. You need to have a certain amount of net worth with the company. You need to have a certain amount of risk appetite and ability to take risk. And you have to go through like this paperwork. It's more like a yellow light. Like you can buy this only under these circumstances or if they ask for it. The final level is when you can sell it on a solicited basis. So you as an advisor can say, I think a Bitcoin ETF would make sense as a 1%, 2% allocation to your portfolio. And that's where we're heading towards for at least some of these platforms.
James, can I ask a question? And for the viewers who don't know, like how many, there's 8 of these Bitcoin ETFs, or maybe a couple more. Yeah, but
11.
But this 11
in the US.
11 of these Bitcoin
Don't
ETFs.
You leave anyone else.
Yeah, I know, right? Well, so we got 11 of these Bitcoin ETFs, and they're all fairly like a lot of them are very sizable. This is unheard of in ETF land. Like we don't have 8 like GDX gold ETF, gold miners ETFs. Like you've got the big one that owns the bid ask spread, and then all the rest. I'm just kind of curious because you're probably you see what they're doing. Like how are these ETFs differentiating themselves, and how is it not just on cost? Is this just a race to the bottom? Are they making money? Like if I was like the guy who's like the runt in the litter and I wasn't like, whatever X billion, like, don't I just say, okay, 5 basis points are free for the next 2 years? I'm just kind of, we've never seen anything quite like this.
Yeah. So 2 things. We have 11 now. There's actually 2 more that will be coming. So Osprey is technically a closed-end trust like those Grayscale products. That will convert some point this year. I think the final deadline for that is like sometime in November. And then we also had Trump just filed for a Bitcoin ETF via Truth Social or TruthFi or whatever you want to call it. So they also have filed now. So we could get 2 more Bitcoin ETFs. You ask a very good question, which a lot of people said there's not going, when these things were filed, it was 10 that were going to be due. So we thought of as GBTC and the newborn 9. Then GBTC spun off their mini sibling BTC. So that's where we got 11 from. You're right. The demand, the overarching decision maker here is going to be cost and liquidity. So right now, the tightest spreads are in IBIT and GBTC, which makes sense. They've been around GBTC's been around for a long time. IBIT owns the options market. They trade at a very tight spread. GBTC is also very liquid. So if you're an institution going in and out in a short period, you might not care about GBTC's 1.5% fee if you're only in there for like half a day, or like you're in there for a day or 2. It's not that big of a deal. But if you're planning to hold for a long term, you're going to care a lot more about those fees. And so BTC from Grayscale is the cheapest right now on an expense ratio basis, but Van Eck has HODL in the US, which is still a 0% fee because they've waived the fee for, I think, until like January. So like that's where a lot of the competing is being done. But you also got to realize there's other people that are leaning into, we have expertise in covering, the crypto markets. So BlackRock and Fidelity are like, all right, Fidelity's kind of in the middle. Like we have a lot of expertise here, but BlackRock is kind of like, we are the big boys in the room and we have all this. We know how to handle ETFs. But then you have other people like Bitwise and 21 Shares that are more focused on like, we are crypto specific. This is what we do. This is how we do it. And that's how they're selling to people. And the other thing to realize, and Van Eck is a good example of like being in the middle as well, right? They've leaned heavily into the crypto space, but they're also a traditional manager that got their start basically on gold and gold miners back in many, many years ago. So they're all trying to differentiate in many different ways. And it seems to be working because a lot of them are doing pretty damn successfully. Part of that has to do with the fact that the Bitcoin they held or the flows they were able to get have appreciated a lot from when they launched at 40K. Exactly. Yeah. So, it's all different things. But the thing is, like, they all have over 100, they have a couple $100 million in assets, even the smaller ones, and they're profitable at that level.
Yeah.
Right. Yeah. So it's just when rising tide lifts all boats. Really.
Yeah. And they're like, and just to confirm, James, there's no parallel to this in anywhere else in ETF land, right?
We have a bunch of S&P 500 ETFs, but like that's So we have 5, I think, of them: SPY, VU, IVV, SPLG. So like, yeah, I mean that's it. But that's also like the largest index in the world that anyone ever tracks, and yeah, it's this. There is no parallel to what's going on here, and part of it is because there's no parallel to the way the SEC allowed these things to launch. Like there is no example historically of launching 10 different things at once. Usually it's first come first serve, and there's actually a letter from Van Eck, from Canary, which you actually used to work at Valkyrie, Steve McClurg, and 21 Shares. So they basically wrote a letter like, stop this launch all at once, because it seems like that might be what's next. They're going to continue doing some of this all at once launch on the same day, because it hinders those smaller issuers I just mentioned. If you let somebody go out first, it gives them a huge first mover advantage. We saw that with the Bitcoin futures ETFs. We see that all the time. Being first matters, right? You saw it in Canada with Purpose. They were out a couple days early, and they are now the leader by far because of that. But the flip side is if you allow everybody to launch on the same day, you're basically handing the win to the bigger companies. Think BlackRock and Fidelity, because they have much bigger distribution. So there's pros and cons to each thing. And so there's a big push to go back to the first to file, first to launch.
It's like the Bitcoin equity.
Like you're handicapping innovation effectively, or, theoretically, right?
And competition.
Right? It's
Hey, now, before we run out of time, I wanted to get on regulations, because I know you follow that closely too. I'm just curious, based on what you're seeing now that we're, 6 months into the Trump presidency, are you seeing real change in how regulators are interacting with the industry and the approval process for crypto, besides just whatever's being said publicly?
Yeah, so it's funny. I get all the time, like, I thought this administration was going to be different. I thought they weren't going to delay these things. First of all, in the U.S., the normal process is you just delay until the final deadline and they approve. It's very bureaucratic. That's just the way things work. And right now we see a lot of talk and speeches being given by the SEC and different people around the government and regulators. And people are like, nothing's actually changing. But that's not true. Like, if you talk to the issuers and people trying to build in this space, it is a complete 180-degree turn. Everyone is singing the praises of people and the way they're interacting. It just takes time. Like, Atkins just got in there like last month, right? Like, things are not really like, it takes time to get things moving and get the ball rolling, but the ball is rolling. There's a bunch of reports out this week. I wrote a note basically saying it's potential that Solana and staking could be the next things up in the U.S. Not guaranteed, but it seems like the SEC is requesting issuers to file some amendments to their documents to try and launch Solana staking ETFs. And the SEC is engaging on these topics. The prior SEC was not engaging on this at all. So they have the crypto task force, things like that in the US. They're working towards getting these things out. They're working towards figuring out a framework for allowing these products to list. It's just going to take some time, but they are moving from everything that I can see. It's just there's not a ton of public, these things are approved and they're happening right now. It's just going to take time.
Okay, that's helpful. Yeah, so the conversations have flipped 180, but that's kind of behind the scenes. So you're not seeing that flow through yet, but it will.
It will, yeah. I mean, our view is like these altcoin ETFs and these Bitcoin ETFs. When we were talking about the Bitcoin and Ethereum ETFs, it was like, what are they going to let through? How are they going to let it through? How is it going to be approved? To now, it's a complete 180 to like, what are they going to stop? Like, we don't know. Like, I don't know what framework they're going to use. What ETFs are going to be allowed and whatnot. So that's kind of how our thinking has completely flipped. And when we talk to people that are actually interacting with the likes of the SEC, that's kind of what we're seeing as well. Again, it's just not. We haven't seen these things launch, but watch out. We will see them launch. We think there's going to be, crypto index or basket products launch this summer as soon as next month.
Well, so that's what I was going to ask you, James. Like, are we getting close to the point where we have enough components for like a crypto, like, fund to fund kind of, or like, you have an asset allocation wheel on like, and I want it market cap weighted and it's going to own all these bits. Like, is that like, are we very far away from that?
No, I mean, the final deadline for Grayscale's GDLC, which is their large cap digital assets product, which is like 90% Bitcoin and ETH, is July 2nd. So our expectation is that will be approved. Either they will come with the framework to approve some of the other assets in there. They hold 5 of the largest crypto products, digital assets. They will either come with a framework and approve some of the other assets around that time, think July, or they'll just approve it and say 10% allocated to 3 other digital assets is enough. It's a low enough allocation that we're going to allow it in an index product. Bitwise has BitW that's due for a decision at the end of July. They hold 10 products, but again, it's still like almost 90% Bitcoin and Ethereum, which are already approved. But again, if they go through and approve Solana and some of these other coins potentially around the same time, then it gets even easier to approve those products. And then we have Hashdex, which also has applied. They have a product right now that is just Bitcoin and Ethereum, but they filed with the SEC to basically says, we have this whole index with partner with NASDAQ. As soon as these other assets are allowed in the ETF wrapper, we want to add them to our index.
Wow.
All right, now before we run out of time, I know you see a lot of what's going on in the ETF landscape. So besides Bitcoin funds, I just want to get your quick take. What are some popular strategies? What would you say were the most important trends last year? What are trends you're watching? Like, help us, for people who play in the ETF space, like what should be on their radar?
Yeah, I mean, ironically, the trend late last year was like gold ETFs. I know that's what you guys care about. They did exceptionally well. It was like everyone was talking about like the central banks buying gold a couple years ago, and the price wasn't doing anything. Gold ETFs were seeing outflows. They did tremendously well into early this year, right? But the other big trends we were seeing, active funds are roaring back here in the U.S. Actively managed ETFs are dominating the flows. They're way over punching their weight for their size of the market.
I think we'll come back. Okay, we might.
There
he is.
Sorry, yeah, I saw. Yeah. Can you hear me?
Yeah. You're good now.
Froze up for
continue.
a second.
Continue.
Yeah, so like any product that is like doing covered call strategies and anything along those lines, those were very hot last year. They're still very hot this year. So anything derivatives, single stock ETFs were also massive. I mean, we don't need, and you guys are probably very much aware of the MicroStrategy 2x long, 2x short products. There's tons of them launching. They all have tens of billions of dollars in assets. They're very expensive now. Those are the main things that we watched last year, and the trends have continued into this year. What I'm watching going forward is in the US, the only person that can launch an ETF as a share class of a mutual fund is Vanguard, and they can only do it on their passive products. We have 64 companies now that have filed to be able to do that, including on active products. And the most recent filer was actually Vanguard, who filed yesterday with the SEC to be able to add ETF share classes on their active mutual funds, which most people don't realize. Vanguard is like the second largest active fund manager in the world. They own a ton of active assets. They're just cheap active. That's the big thing we're watching going forward.
It's the dude that I ride the bus with. He's the active manager of the second. It's like I've never heard of one active portfolio manager for Vanguard. And no doubt they're the second largest. Like, that's crazy. That's a crazy stat, man.
Yeah, most people don't realize it. When I think they are the largest actively managed fixed income provider. If not, they're the second largest in the U.S. Wow. So a lot of the ETFs they've launched recently have been active too. So they're leaning heavy into the space. So, but yeah, ETF, and you guys up in Canada already have this. I'm pretty sure you got mutual funds that can have ETF share classes and ETFs that can have open-end mutual fund share classes. The US, it's just the only person that can do it is Vanguard, and that's going to change, we think, this year under this new SEC admin. So they're working on that. The SEC is working towards crypto regulations, and we're very optimistic on the space and ETFs that are going to get approved.
That was an amazing roundup, James. Thank you.
Like, you know what? It's always so enlightening and illuminating for all the stuff that's happening. I have no idea how you can keep track of all of this stuff. It's insane. But
you need ChatGPT in your pocket or something.
Oh, man.
I need to start using it more.
Yeah. You
don't we all? Don't we all, though?
You don't got time for that. James, an absolute pleasure. Thanks so much for always being here for Hard Money and Commodity One-on-One. Always a pleasure. James, thank you. That's James Seyffart, Bloomberg, the #1 ETF analyst on Earth.
Thank you, James.
Thanks, guys.
Oh, man. He's a human ETF computer, man.
Yeah.
Like, you literally bringing the heat for like all that's happening on ETF land.
Man, that was great. We're going to definitely run that back for people in future days. Like, that's something you don't want to miss, to see what's on your radar at least. And it looks like good days ahead for Bitcoin, as we're seeing. But okay, Hard Money, we're just getting started still. We got a lot more great guests, so don't go anywhere. We're going to be back in just a second.
Welcome back to Hard Money. Trust you guys have been enjoying it. We have a treat for you. Chris Wood, partner at Grizzle, global equity strategist at Jefferies. Let's bring him up. Chris, it's a pleasure to have you join us. Thank you so much. Thank you for joining us at Hard Money. A partner at Grizzle. Great to have you here.
Great to be here, Thomas. Yeah.
Thank you. Chris, could you take us through the case for hard money assets, why they are so valuable in the current macro backdrop?
Well, yes, maybe I think it's worthwhile going over the brief historical context, Thomas. So the historical context is that the US dollar, the link between gold and the US dollar was formally removed, I believe, by Richard Nixon in the early 70s. I think it was 1971 or 1972. So since then, we've been living with the US dollar as a reserve currency of the world. But the reality is the US dollar has had no fundamental discipline attached to it because of the removal of the link with gold. So back in the 70s, that made very people suspicious of the dollar at that period. We had a lot of inflation in the 70s. But then former Fed chairman Paul Volcker restored the credibility of the dollar at the very late 70s, early 80s by imposing very high interest rates in the US, 15, 16%, very high real rates. And that basically brought credibility to the US dollar. Paul Volcker was the most genuinely independent Fed chairman since I've been looking at markets. Obviously, he was very politically unpopular at the time, but he defeated inflation. And he basically triggered this 40-year bull market we had in treasury bonds from 1980 to 2020. But the clock has been ticking on the US dollar paper standard because since about 1999, the reaction of the authorities to any major problem, and particularly the monetary authorities, the Fed in the US, has been to bail people out when problems emerged. With that whole process of bailouts had its origins with the bailouts of the long-term credit hedge fund back in 1999. Then we had incremental bailouts going on, be it the S&Ls, but we had the spectacular across-the-board bailouts in the global financial crisis in 2008, when the Fed embarked on unorthodox monetary policy because they cut rates to zero and then started expanding the balance sheet. And then we had the ultimate bailouts with the pandemic when the monetary expansion was off the charts. And they not only bailed out specific institutions, they basically bailed out the whole corporate bond market. And the massive monetary expansion in 2020 triggered the biggest inflation surge since the 1970s. And that growing socialization of credit risk in the US has gone hand in hand with the expansion of the Fed balance sheet. And so this is a situation where people want to, it makes sense in my view, to have some hard money hedges. But basically in 2009, they bailed out the private sector players by massively expanding government debt. But now, in the period since 2009 and 2025, the real debt expansion has not been in the private sector, it's been in the government sector, government debt. And since 2020, the US fiscal situation has gone from being, of concern to be actively dangerous. So you've seen a lot of more prominent people, be it Jamie Dimon, Ray Dalio, warning of the fiscal situation. We now have evidence long into the Treasury bond market moving on supply concerns. So people now question the assumption which ruled for many years that US Treasury bonds are risk-free. And so the way I look at it is that it makes sense to own hard assets as a hedge, and the two preferred hard assets are gold and Bitcoin.
That's a fantastic overview, Chris. It would also be great to get your thoughts on Doge and what Elon Musk was trying to do. Is just the fiscal problem too big to be reined in?
Well, Thomas, for many years, worthy people, well-meaning people have been warning about the fiscal deficits in the US. But actually, between 1980 and 2020, I remained bullish on Treasury bonds because of the disinflationary trend. And I didn't believe the bond market was going to sell off on fiscal concerns because it wasn't that extreme. And actually, my base case was that the bond market would trade in line with nominal GDP growth. So nominal GDP growth accelerated, bonds sold off, yields went up. When nominal GDP growth contracted, bond yields went down. And that's why bonds were a good hedge. Owning bonds made sense as a hedge to owning equities, i.e., if equities sold off, bonds would rally. So back in 2008, when the financial system blew up, stocks collapsed, but the Treasury bond was a good hedge, and that's why this strategy called risk parity worked. However, that whole way of investing, in my view, stopped working in 2020. So my basic view is that the fiscal excesses were already growing following the bailout in 2009. But the Fed went completely over the top in 2020 when the Fed essentially panicked with this monstrous, I think is monstrous monetary expansion, which was triggered by the scare on the pandemic, where the Fed essentially printed money to finance all the handouts. So the Fed basically adopted a policy more akin to modern monetary theory. And that's when it became appropriate to start worrying about inflation first, because in 2009 they bailed out institutions, but they didn't put money in people's pockets. In 2020, in the G7 world, not the emerging market world, but in the G7 world, they put money in people's pockets. Or to put it more crudely, they pay people money to do nothing. And because it went in people's pockets, it turned out to be inflationary. And so that's why the Fed had to start raising rates. But at the same time, the fiscal situation has become much more extreme. I'm talking here the US. So I think a key number to focus on right now, if you want to highlight the fiscal situation in the US, is that because of the higher rates, the higher bond yields have made it much more uncomfortable. So net interest payments plus entitlements in the last 12 months are running at 94% of total federal government receipts. And that's an environment of healthy revenue growth because the US economy is growing. So when I say entitlement, I'm talking the two key entitlements of Social Security and Medicare. And most people in Washington believe they can't be touched. So if you've got the major entitlements and net interest payments running at 94% of total federal government receipts, what that tells you, if there's ever a downturn in the US, when tax revenue will go down, the fiscal situation will not become viable. And that's why when Donald Trump announced his tariff agenda, a month or so ago, April 3rd, what he called Liberation Day, that's why the bond market started to panic, because investors saw the tariff agenda as increasing dramatically the risks of a recession, because the tariffs would amount to a tax hike on ordinary Americans. And that, in my view, is why that's a key reason why Donald Trump has effectively done a U-turn on his tariff agenda. Because the bond market selling off were basically saying that the risk in the US is that bond yields go up in a downturn, which is not what is meant to happen with a risk-free security. But often in emerging markets, you see bond yields going up in downturns if the market doesn't trust the fiscal situation. So to me, post-pandemic, the fiscal thing has got to a situation where it's market moving. It's no longer just a subject for academics to discuss. And Elon Musk's agenda, Elon Musk arrived with a dramatic agenda at Dodge to take $2 trillion out of the federal budget. If he'd really done that, actually, you would want to own treasury bonds and you'd want to own the dollar. You wouldn't want to own the stock market in the short term, because while it would be very good for the stock market in the medium term, it would be a big deflationary hit short term. So at the start of this year, we had to consider that, at least I had to consider that my core narrative could be wrong, because my core narrative since the Fed printing in the spring of 2020 on the pandemic, my core narrative has been that treasury bonds have entered a structural bear market after a 40-year bull market between 1980 and 2020. But if Elon, as I say, there's a chance that Elon Musk could do this, because we know from his track record that if Elon Musk spends 6 months to a year in Washington, he can probably achieve a lot. But we now know he's essentially left Washington, and the problem is, to really do what he wanted to do, he had to cut the entitlements, and I don't think there's a political will to do that.
And that really is the challenge here, the political will. When you have a set of elections every 2 years, it becomes untenable to get anything meaningfully done.
Yeah, basically the only way to address these fiscal situation is to acknowledge that something has to be done about these entitlements, which I believe Jamie Dimon said on more than one occasion. So in a world where they don't really address the issue properly, just hypothetically assume they don't address the issue, that means that in a world where bond yields go, my guess, in a world where, for whatever reasons, a 10-year Treasury bond yield breaks through 5% and starts moving towards 6%, that's the world where the fiscal arithmetic stops working, and that's the world where the pressure will come on to adopt policies of financial repression, which in the first instance will put pressure or create incentives or pressures for financial institutions in the US, like banks, to buy more treasury bonds to fund the government. But ultimately, if that doesn't work, then the authorities will be tempted to do what the Japanese authorities did from 2016, and that is to fix the price of the long-term bond yields, despite the central bank guaranteeing them by them a certain price. And in that environment, while your bonds don't go down in price in nominal terms, they go down in price in real terms. And in that environment where they fix the bond yields, then the pressure goes on the currency weakens. And that's what happened in Japan from 2016, where they were fixing the Japanese long-term government bond yields, and you had a big decline in the yen. So that policy is called yield curve control. And that is one obvious potential end game for dealing with this. The virtue of yield curve control is you keep the cost of financing. You should try and keep the cost of financing the debt below the nominal rate of growth, because that then allows the real value of the debt to go down. But the pain is taken by the holders of long-term bonds, because the real value of their bonds goes down, and the pain is taken by the currency. But if you're just sitting on your treasury bonds and you don't really understand what's happening to inflation or the currency, you might not be aware of what's going on. So we had yield curve control in the US in the Second World War for I think about 5-6 years. They fixed the price of the bonds, but then there was a reason they did that. They were financing a war. But right now, someone made an appropriate comment the other day. We've got fiscal deficits in America more akin to wartime financing, but we haven't got an extreme situation. So the bottom line, as far as I'm concerned, ever since they printed the money in 2020, you can own treasury bonds tactically, but structurally it makes zero. So I've been saying zero weighting to all G7 government bonds since March 2020.
In a conventional asset allocation view, that'd feel quite radical. I wanted to touch on that. Like, how should a millennial think about it?
Well, there's even less reason for millennials to own the treasury bonds, obviously, because
maybe your thoughts on this conventional 60-40 asset allocation.
No, my view is very simple. You do not own treasury bonds. So for people who want to own fixed income, in my view, let's say you're US based, and you want it for whatever reason you want to own long-term bonds. In my view, it makes much more sense to own the long-term bonds of the best US corporates, who have far superior balance sheets to the federal government, who also, by the way, locked in the borrowing rates when yields were very low, pre-pandemic. Whereas the federal government, the other problem with the federal government is that 50% of the Treasury debt outstanding is short-term, expires in 2 years. So they're very dependent on short-term financing, which is intrinsically risky. But personally, on government debt, I've had a global sovereign debt portfolio I've been running since March 2020, and that essentially is only in local government emerging market bonds. So I give you an example. I have a low-yielding bonds in a country like China, which has done very well, the bond market, but the yield's very low. But you can buy the Brazilian local currency 10-year bond today. At the beginning of this year, it was 15.5%. It's 14% when I last looked at it. So if you're getting 14% in a government bond, you're kind of paid for the fiscal risk. The fiscal issues in Brazil, they're not disastrous, but they're bad. But the point is, you're being paid 14%. You're not being paid, you're not being paid that risk premium in American government bonds. And all these G7, most of these G7 countries, US, UK, Japan, France, the fiscal situations are extreme because all these governments have these very bloated welfare states and entitlement programs, and the politics is not prepared to address it. The one place in G7 which has real room to crank up borrowing is Germany, and they have now started that process because they revised their borrowing limits, which is why the German stock market has rallied this year.
It would be great to get your thoughts on transmission of fiscal weakness to the currency, specifically the US dollar, Chris.
The base case, until proven wrong, is the dollar's probably made a long-term peak here. So the base case when Donald Trump was elected, it was that we would get a repeat of what happened when Donald Trump was elected in 2016. What happened then was that the dollar rallied on the cyclical optimism triggered by Trump's victory, just as it did late last year, because you had a huge surge in the small business confidence index after the victory in November 2016, same in November 24. But then the dollar actually started to weaken when Donald Trump entered the White House, and actually Donald Trump himself wants a weaker dollar. So even if nothing dramatic happens, you should expect the dollar to weaken. But this time around, the fiscal situation is more vulnerable than it was in 2016. And clearly Donald Trump wants to extend the tax cuts. We've got this bill in Congress, but the whole point of Elon Musk and Dodge, the original idea was that Elon Musk at Dodge would establish fiscal credibility, which would give more space for the tax cuts. So obviously that's not really happening now. Then the next idea was that these tariffs would create a lot of revenue, which would create room for the tax cuts. But of course, the market now thinks, I think correctly, that the tariffs are going to be nothing like as serious as what was originally threatened. My guess they end up 10% across the board. That's not going to provide enough revenue to really cover this tax bill. So that's why, the bond markets become the key variable to monitor. And listen, if the tax bill gets passed and the 10-year bond yield doesn't get above 4.5%, that means for now the market's giving Donald Trump a pass. But in the big picture, the dollar was already very expensive. The dollar, if Americans go abroad, the dollar buys a lot. If foreigners go to America, America seems very expensive. So the dollar has likely peaked. But if the more aggressive parts of the Trump economics agenda get implemented, there's a paper by a guy called Stephen Miram, the chairman of the Council of Economic Advisors, which discusses this theoretical Mar-a-Lago Accord, which probably won't happen. But if the policy outlined in that paper is ever implemented, in my view, that would lead to a collapse in the dollar. And what that paper is arguing is that in exchange for a so-called security umbrella, foreign creditors to America should agree to own long-dated treasury bonds, locked in, and even accept an interest rate haircut. That's in a world where America is hugely dependent on foreign capital. I don't think that policy will be implemented. It's true. If it was, there'll be a collapse in the dollar. The only two countries I can see in the world going along with that agenda is Taiwan and Japan.
Right. Now, with respect to gold, and given that no G7 currency is on a strong footing, would it make sense to hedge your assets back to gold right now?
Yeah, no, yeah, well, gold's obviously done well already, but if you bought gold the day the Bank of Japan announced yield curve control and you were living in Japan, if you see what the gold price did in yen terms when the Japanese were running yield curve control, it went up a lot. But in the last 2 or 3 years, the gold has even gone up meaningfully against the strongest currency in the world, paper currency, which is the Swiss franc. So, but for American investors sitting with this expensive dollar, because the dollar, although it's depreciated this year, it's 112 against the euro. I mean, it got nearly touched parity. It's around 112 right now, but it wasn't so long ago. Euro dollar was 150. So the US dollar can go down a lot more. It's also the reality is that Donald Trump wants a weaker dollar.
Right, and that which he's been explicit about. I want to touch on the Donald Trump presidency. This one versus the last one feels a lot more chaotic this time around.
Yeah, well, I mean, so the tariff, it's obviously a little bit chaotic. So, but Donald Trump, basically, to be fair to Donald Trump, he campaigned on the fact he's going to introduce these tariffs. He's always been obsessed by tariffs, but he's only actually doing what he campaigned on. And he does have a habit of trying to implement what he campaigned on. Most people in the markets, though, have been of the view that these tariffs were primarily a negotiating tactic. So the reason when he announced such high tariffs, the market got generally scared because basically these tariffs of that magnitude will act as a retrogressive tax hike on ordinary Americans. Now, I think politically, if I was advising Donald Trump, clearly the tariffs do work in a negotiating tactic. But the problem politically, my view is that many Donald Trump supporters probably believe that tariffs are paid by the exporters, not by the end purchasers of the goods. But actually, they're first and foremost paid by the people buying the goods. So actually, I think there's a big political risk if you really implemented that agenda, because I don't believe his supporters fully understand it. Second point, I think it's very likely to cause a recession. Now, I think there is chances of a recession that reduce significantly in the US, precisely because Donald Trump is essentially backing off the whole agenda. So most people in the markets now think he's looking for an off-ramp. He's obviously not admitted that, but the practical reality of market sentiment, the reason the market has rallied like it has, is precisely because people believe he's not going to implement the tariffs, or maybe 10% max. And that's why I've just recently been in the US, and this phrase "tacos" on everybody's lips. It's also become clear that it's become very clear to most investors, and I have the same view, that the practical evidence suggests that the US has no leverage on China on this issue, because the reality is that if they really implement the tariffs, the US started this thing, so the Chinese just respond. But in a world where they really implement these crazy tariffs, the Chinese are more willing to take the pain than the US. That's become very clear. It's not like the Chinese want the pain, but they're not going to. Most particularly as these things were basically imposed on the Chinese unilaterally. So the latest evidence is that basically it looks like the US blinked first. They asked to talk with the Chinese. And I believe literally at the end of last week, we had an indication that President Xi and President Trump have spoken. So that's actually a good sign. And so I think there is actually a chance there's a deal, because one way to give Donald Trump a win from the Chinese perspective, I'm not saying this is going to happen, but it could happen, is to offer to move production to America. Because Donald Trump, apart from one of Donald Trump's reasons for doing tariffs, which he always says, is he's imposing these high tariffs because he wants to create an incentive for production to be moved to America. So why not, the premier Chinese battery maker, CATL, it's got factories in Europe, it could have factories in America. There's nothing, and that would, from a Chinese perspective, turn a negative into a positive. So this is not impossible, but in recent, the U.S. has been. The problem is the U.S. have been also creating a hostile atmosphere to China by seeking to ban the Chinese buying advanced semiconductors. The NVIDIA boss criticized this policy in public a couple of weeks ago. But then the US, on the same side, is asking the Chinese to relax their restrictions on rare earths. So the Chinese are basically making it very clear that, because the US are not backing off the semiconductor controls on China Hesketh, that the Chinese have started to use the leverage of rare earths. And again, this was all started by the US.
Right, and as you've made clear, it's having the exact opposite impact. It's making China more competitive.
Yeah, so let's say the national security guys want to stop China getting the semiconductors. But actually, I would argue, in fact, I've argued ever since they started this policy, but what's interesting is the NVIDIA boss has made the same argument that, in my view, this policy of trying to stop the Chinese getting advanced semiconductors is actually contrary to the US national self-interest. First of all, it creates this massive incentive of the Chinese to do it themselves. And, I'd back the Chinese to do that on a 10-year view. Whereas the Chinese were not expecting this policy, so they weren't 100% incentivized to do it by themselves. Now they are. Second point, the policy deprived America's leading tech companies of a huge amount of revenue opportunity costs, of which NVIDIA is only one example. China was their biggest customer. Donald Trump's trying to promote China buying US goods. This had the opposite effect. And this policy was not, I should make it clear, this policy was introduced under the Biden administration, not by Donald Trump. Third point, based on what I heard in Taiwan late last year, at least 10% of NVIDIA's banned chips ended up physically in the mainland market last year via the second-hand market in places like Hong Kong, Singapore, Malaysia. So it's not really practical either, this policy.
Yeah, because they're going to find a way to get these chips eventually, and you'll get competitors like Huawei. As you've highlighted, they've taken so much market share already.
Well, yeah, so Jensen basically said he cited numbers of the loss of market share from NVIDIA to Huawei. So yes, it's counterproductive. The other point is the stated rationale of this policy. The stated rationale why they introduced this policy in the first place was that these chips could go into weapons of mass destruction, which implies that the Chinese are about to invade people. The practical reality is there's zero evidence as of today of the Chinese invading anybody. China has not invaded anybody. What China has done is it's built, it's got this bridge and road program where they build a lot of infrastructure, but they haven't invaded anybody. So the Chinese understand that the real motivation of this policy from the point of view of the national security lobby in Washington, and Donald Trump's not a national security guy, but a lot of these guys in Washington, the real motivation is to try and stop the Chinese from upgrading their economy because of this concern that China is a threat to US hegemony. But the reality is I don't really believe China is a threat to US hegemony. The Chinese have got very bad demographics. They need to upgrade their economy and productivity because otherwise, it's hard for them to grow because they've got these very negative demographics. So yes, so the US backs off that whole agenda, then the Chinese will back off completely on the rare earth restrictions. So this doesn't have to be or negative, but the national security lobby continues to control the policy, which is a big if. Then things can obviously get a lot worse. I mean, worse from the point of view of then you could end up with a total division, in the world economy. But right now, China's running a record trade surplus and China's exporting everywhere. China, the last data we have is all-time record trade surplus in China.
Incredible. Chris, and maybe just to get your thoughts on emerging markets and your favorite current EM countries?
No, for people who want to put a bit of money in emerging markets, my view is if you want to just buy 3 emerging markets who are all different, but I would say, but are quite liquid and they're easier to buy, I would say India, Brazil, and China.
Right, and would you view that as a stock pickers market, or will an indice type ETF do?
No, but yeah, it is a stock pickers market, but also you can buy. It's not disastrous buying the indices. It's not ideal, but it's not better than doing nothing. But India is expensive, a bit like the US expensive, but India is the best growth story in emerging market equities, but it's also one of the most expensive. China is China is basically quite cheap, and it's in its own cycle. So China's not going to be correlated to what's going on in Wall Street, where the markets are. And Brazil is extremely cheap because of very high real interest rates and concern about the next permanent election. But all these markets, these big three stories are different from each other, so they're diversified.
Great. And just wrapping up on the hard money theme, we've talked about gold at length and the US dollar. You've been bullish on Bitcoin, and you've been very early. We've published reviews, and it would be great to have your thoughts on Bitcoin here over 100,000 in relation to other hard money assets, particularly gold.
Well, they have different characteristics, but it's perfectly plausible to own both gold and Bitcoin. What I tell the baby boomers, the reason they should think about owning Bitcoin is because millennials may never buy gold. But the reality to only buy Bitcoin is a bit risky because gold stood the test of time. So my view we should own both. I think Bitcoin became more mainstream from about 2020 when institutions could get custodian arrangements for owning Bitcoin. So far, Bitcoin is not. It should have done better on the post-halving cycle, but I think the natural cycle of Bitcoin post this halving has been somewhat distorted by. First of all, we had the Bitcoin ETS being launched before the halving, so we had a bit of the rally before, but then we've had all this distraction of meme coins early this year, which actually is a negative for Bitcoin crypto because it's kind of damaged the brand. I don't think it means you don't own Bitcoin. I just think it's kind of delayed the next rally in Bitcoin. So for people who own no Bitcoin, that's an opportunity. Because I don't think it's fatally damaged the brand, but it's definitely damaged the brand. Yeah.
Yeah, for sure. And the other part I wanted to ask you was get your thoughts around quantum computing and Bitcoin.
Yeah, but so that's obviously a reason why you should have gold too. But everything I'm hearing is that's some years away. But you are hearing that, like in Bitcoin ETFs, they do put a provision and the risks on that. The thing about Bitcoin there and the whole Web 3.0 is basically meant to be decentralized, right? So that was the whole theory behind it. Well, it's true, that's the way it is, but it's very different from the current situation we have in the internet economy either in China or the Western world, which is dominated by a few dominant tech franchises. But to me, so far, Bitcoin should be given the benefit of the doubt because it survived some pretty dramatic stress tests.
And just big picture on AI, because it's all dominating, how would you compare where we are in AI, say today, versus the dawn of the internet? Like, is it that type of mega trend? And how early are we?
Well, obviously AI is attracting a lot of attention. The big US tech companies, the hyperscalers, are spending a lot of money. I think it's about 330 billion US projected this year by the four major hyperscalers. So I think they're investing that money because of the big growth opportunity in AI, but they're also investing that money because AI is also the big potential disruptive risk, particularly for these dominant tech incumbents. So to me, historically, they've each been in their own moat, these hyperscalers, but they're now actually all converging on the same area. So they're kind of beginning to drain their moats by investing their cash. And if they're clearly successfully monetizing AI, the stocks can do well. But if they're going to be disrupted by AI, these very highly capitalized stocks could collapse. So I think it's bottom up. But the other point for people to be aware of, if you believe in the whole crypto blockchain story, which, as I said earlier, is intrinsically decentralized, then the question is, do AI applications emerge in that world? Because if they do, then they have the potential to disrupt this whole cloud way of distributing everything. Now, I'm not saying that's going to happen tomorrow, but that's an issue on a 5-10 year view, because this dominant big tech incumbency of this few major tech franchises, not just in the US but globally, is actually completely the inverse of the principles behind what the crypto enthusiasts call Web 3.0.
Correct. And some of the hardcore Bitcoin Bitcoin purists, they don't like centralization of these Bitcoin ETFs.
No, I think from a purist standpoint, they're correct.
Right.
Yeah. So there's a bit of a division, but on the other hand, if you're running a Bitcoin, if you're like a Coinbase running a business, you needed some regulatory clarity, right? Because you didn't know if what you were doing was legal or not, because the SEC didn't tell you whether you were security or weren't you. How were you regulated? So, they did need some. And, we've seen there have been apart from the purists, there's been some big scams coming out of crypto too. So the reality is crypto since it began has been a combination of well-meaning libertarians and crooks.
And the libertarians have been backing Bitcoin, and the crooks have been backing the meme coins.
Yeah. The bottom line is, if you believe, you were always going to have some element of regulation coming in. What made no sense was the situation we were in for the last few years before the ETS, where trading Bitcoin futures was legal, but cash Bitcoin wasn't allowed. That made no sense. And that's because I think the reason for that was the commodity regulator was in charge of futures, and the SEC was in charge of cash. So look, it's good that it's good, I think there's more regulatory clarity.
Yes, 100%. Chris, that was a fantastic overview. Great set of great topics. We want to thank you so much for joining us for Grizzle Hard Money. Always a pleasure. Thank you so much, Chris.
Thank you, Chris.
Thank you, Thomas. Good to see you.
Man, Hard Money, what a guest. Chris, his insight's second to none. So we were happy to chat with him. Hopefully you got as much out of it as we did. Don't go anywhere. We're just getting warmed up. We got a lot more guests. We'll be right back. Welcome back to Hard Money, man. That last guest, Chris Wood, isn't it great? You've been seeing all his research on Grizzle, and now you see him in the flesh. That's why he's a legend. Chris is dropping some bombs there, some knowledge bombs.
That was fantastic. Now we got a great corporate on deck. First Nordic Metals, Taj Singh, CEO. Let's bring him up.
Taj, welcome to Hard Money.
Taj, how are you? I like that jacket, man.
Wow.
That's
new,
off-season work, man.
It's from Sweden, man. It's from Sweden.
That's right.
Wow, that's a beauty.
The threads from Sweden. Oh, man. First Nordic Metals, the belle of the ball the bell of the Nordic bull. It's Taj, a pleasure, man. You know what? We had such a good time. For those who did not see, Grizzle and First Nordic and a host of other companies put on the greatest PDAC event ever, Taj.
It was a good time. A lot of really engaged people, good thought sharing, good energy to start off PDAC. It was really good. It was great.
And we've just committed to a summer soiree, have we not?
Really? I might be late for it.
We'll make it happen.
Taj, always a pleasure. Thank you for joining Grizzle Hard Money.
Now, Taj, you guys are working on some really interesting stuff, so I definitely want to pick your brain here. First, I want to start high level. You have a lot of experience building and selling gold and silver companies. So I wanted to ask your current thoughts on gold. You know, what inning of this bull market does it feel like based on the conversations you're having? How do the current fundamentals you're experiencing on the ground compare to past cycles? Give us some thoughts.
Yeah, it's a bit different, this one. But if you had to kind of ask me for an inning we're in, I feel second inning-ish. I think it kind of started the beginning of the run-up started kind of early part of 2024, mid 2024, when we started blasting through high 2000s and into 3000s. You know, there's all the indicators are there. Significant central bank buying, money printing phase. There's still very limited new capital inflows, but the producers are getting this valuation re-rate significantly. That should flow down to the developers and then explorers, and then those guys, they get even more torque. But you know, listen, global political uncertainty is still there. So it's all there. All the ingredients are there, and I think we're in one, and we don't even know we're in one. But the producers are for sure feeling it. The developers, explorers like us are gonna feel it for sure. So it's definitely exciting to see we're just in the beginning here.
Yeah, so things are heating up, but still no dollars are coming easily. You got to fight for the dollars that you raise. Is that fair to say?
Yeah, good assets, good management teams. You know, teams who've done it before, good jurisdictions. Those are the ones that are getting the money. It's not the kind of cycles we saw before, where it's just boom, all the money's going everywhere, and even some of these kind of lackluster, subpar assets and teams are getting it. They're still being very picky. So you know, we've made sure.
We're not talking about the fire hose of money, you know, just fill in the coffers of juniors. Like this is, you know, which is an advantage for companies like First Nordic, in the sense that, you know, the companies that are continuing to get financed. There's almost an edge to this for investors, right?
Exactly. Yeah. Like anything that I'm going to go in now is the asset there, is the jurisdiction there? Are we going to build the right team who's done it before? Once you've covered those, regardless of cycle, you should be able to go get money. You know, the quantum might change, but you got to just grind. And if you can grind with the fundamentals of the commodity being there, you'll get the money. The right projects and the right teams will get the money. Exactly. And it for First Nordic, actually, it's working out as an advantage. Exactly.
Right. Great. Now, Taj, for anyone who doesn't know First Nordic, could you just give us a brief overview of your key assets? I'll throw up a little chart here that kind of lays it out pretty well.
Yeah, so we're focused on Sweden and Finland. Primarily, our current focus is in Sweden on the Gold Line Belt. On the Gold Line Belt, there's kind of three main project areas. One is the Barsele project, which is a joint venture project with Agnico Eagle. There's a 2.4 million ounce resource there, and hopefully will continue to grow. And then the project packages around it are called Paubacken and Storjukten. So in total, we have 100 kilometers of strike on the very underexplored but really prospective Gold Line Belt, one of the few remaining greenstone belts left to really explore. We're the first movers there, so that's 100 kilometers of strike. Not easy to find a junior with that kind of land position, with so many targets that are ready to progress towards drilling and hopefully discovery and delineation. And then in Finland, we have an interesting project with a maiden resource of around 300,000 ounces. It's a previous Agnico Eagle asset. It's a gold silver asset, high grade, starting at surface, that we hope to continue to work on as well. And then just wanted to point out the JV that we have at Barsele is the JV. The remaining ground around it is 100% owned by us. So definitely good position to be in.
Great. Now, I'll get into Barsley in particular, but I just wanted to ask a question. You said that you have a large land package that's unique for a company of your size. Now, I'm going to throw up a slide from your deck. It's a great one, comparing the Abitibi in Canada to the Gold Line Belt. I'm just curious, why is there so much less production happening in the Gold Line Belt in this region of the Nordics, given what the Abitibi showed the world could be the potential from greenstone belts?
Yeah, there's about 6 or 7 major greenstone belts in the world, and Abitibi is one of the more well-known ones. It's probably the most productive greenstone belt in the world, and these greenstone belts, this geology, are amazing and fantastic hosts for gold-rich deposits, some base metals as well that could come along with it, but they're known for having very, very productive deposits, for being host to very, very productive gold deposits. The main reason, the thing that's happening here is the geology is extremely similar. Age of the rocks, type of chemical and physical characteristics and chemical composition of the rocks, very similar. Similar kinds of events that mineralize these rocks also happen. But what the difference is Canada was kind of open to exploration 75, 80 years ahead of where you're seeing the Gold Line Belt, for example, because foreign investment wasn't really open. The Nordics, Europe in general, wasn't open for foreign investment till kind of the late 90s, EU coming on. So it's like almost a century behind for exploration. And now things are catching up 15, 20 years into it. They're starting to do some modern exploration techniques. Throughout the Nordics, Finland has had a nice boom here with a bunch of deposits being found and quite a bit of M&A happening. And Sweden's kind of now following. But yeah, it's mainly related to the fact that it just hasn't had a lot of work done on it. So that puts us in a good position because we were able to go stake all that land, put 100 kilometers together, which I don't even think there's not many mid-tiers or larger producers who even have that kind of land position. So we were able to put that together and kind of our thesis is there's a 2.5 million ounce deposit that we think can grow well past 4. But those don't really come in isolation. You're going to find 2, 3, 4 more deposits on over 100 kilometers, right? Considering that 2.5 million ounces only takes up a kilometer or 2. There's bound to be more deposits there because all the plumbing's there for stuff to get mineralized. All those fluids move through. So it's an exciting position for sure to be in to be able to hopefully discover a bunch of more multi-million ounce deposits.
Yeah, it's one of the best charts I've seen, just laying it out where, the geological potential is there for the Abitibi. It just shows up by you being early, like how big a position that is. That's just smart of you guys to put that chart in there.
Yeah, I feel like it's some of the guys who are more well-versed in the field or the institutional investors, they get it. But kind of putting it out in the graphic, and especially for the retail investors, it's really powerful kind of saying, look at, on the Abitibi, on that same 100-kilometer trend, you've got 15, 20 companies fighting over ground with like 200 million ounces of production in the Abitibi, even over that 100-kilometer trend, 100 million ounces. There's probably 50 million ounces in resources now. Like there's something here. And it's a pretty powerful image. Yeah.
Taj, you were just up in Sweden and you had analysts up there. Maybe you can give us a little bit of insight as well. Like obviously, we have a lookalike here. Is Sweden pro mining? Like, maybe you could just talk us through, the opportunity there that, just from a regulatory perspective, why, Sweden is open for business.
Yeah, so I'll cover a couple things on that. Yeah, so first of all, last week we had 24 people at a site tour, so non-F&M, 24 people, like 13, 14 different sell-side analysts, 6, 7 buy-side analysts, and then the remaining kind of big investors, and from across the globe. So you had North American representation, European representation, even Asian. So anyways, listen, I think it was great. I think what they really saw was the infrastructure that was there, right? You think you're in the north, there's nothing around, whatever. The capex is going to be, pretty high here to get everything set up. Then you go there, 45-minute flight from Stockholm. You're basically at the major city that's near us, and that's another, 4 to 6 lane highway drive right to our drill rig. We're driving up in a Volvo. It's like you're on a picnic. Power lines everywhere. The
That's
Swedish,
great.
the Swedish picnic. But power lines everywhere, rail everywhere, cheap power, the cheapest power I've ever seen in a first world nation. Seriously, like 3.5 cents a kilowatt hour. That's about a third of what we have in Ontario and Quebec, which is already low. So that's
Is that
like all the
Josh, is that all hydropower? What kind of power do they have up there? It's hydro.
Hydro, yeah. So you're going to be making green gold, man. That's
you got to change your name now. You got to change your name. First Nordic Green Metals Gold.
Exactly. So it's and to your other point about Sweden's view on things, it's like changed drastically. Like I think maybe about 5-10 years ago, it's Europe. They're tough on mining. It's like the Nordics is its own world. Like they've been mining since like over 1,000 years. Some of the largest original mines in the world were in the Nordics. And, iron ore, copper, precious metals is now starting to get there. But like the mining is through and through. It's in their blood in the Nordics. So what's actually happened now is I think with the whole kind of EU critical materials, critical minerals, and kind of being independent and having your own supply chain, there's a huge push now to say, hey, guys, we have the resources here. Let's start moving them ahead so we can be independent, if you will. And so it's been a huge push, like the government in Sweden, federal level, and as well as at the kind of county level, which is state level, and the local level is very encouraging for these projects. So it's like I said, it's a perfect time to be moving projects ahead. 3 mines, brand new mines, came online last year. And it's like there's total about 16 mines. Now it's a small country, guys. It's under 10 million population. But 3 mines in 1 year. There's probably another 1 or 2 coming on this year. It's like a huge push. And considering it's such a small country, just back to the mining, it's an anecdote I use a lot, but like 60 to 65% of global mining equipment worldwide, underground global mining equipment, comes from Sweden. Global. From a country with such a small population, they're good at mining. They're very good at it. And then again, the infrastructure advantages you have here, the keeping the costs down, both from the operating level and the capital level is huge. So it's all kind of all the boxes are being ticked right now for us.
Yeah, this is not an alien land to seeing drill rigs, right? Like this is part of the culture.
Yeah, exactly. Like they've got a repository there that's not far from where our exploration camp is. It's got 4 million meters of core there. Like you walk in, it's like Indiana Jones. The lights turn on. You're walking for like 2 miles down, and it's all chronicled and archived by the Swedish Geological Survey. All the core across the country. Yeah. So it's like there's a really good database to start from.
Library. Huh? It's a core shack library. I just kind of come in, give them my card, and check out some stuff.
Yeah, no, and it shows how much they've chronicled. It shows how much it's kind of like I said, geology and mining is part of the fabric of life there, and it's just that foreign investment for modern exploration hasn't happened, and now we're right there and in a good position.
Now, I'm sure you get this question from investors in like your meetings, so I wanted to ask it here. Could you just take us through your vision for First Nordic? I mean, do you want to build a first-class resource first? Is it moving Barsele to production? Do you want to ultimately sell at a premium to a major? Like, what does success look like for you?
I think you have to when you're trying to execute a plan and move a company forward, you have to be kind of open to all avenues. And I think what we're trying to do, you can't kind of say, here's the exit point, this is what's going to happen. It's, right. We're trying to set this team up and the company up that this is a mine, period. That's a question that you'll get as you move along projects. And it's like all the technical guys have this question, is this a mine? And I'm a technical guy. I've been in here for moving towards 3 decades now, but in mining, it's like, this is a mine. That's it. It's a mine. It will be a mine. Who's going to be operating and producing it? Who knows? But we're building a team so that we can advance it, de-risk it, and we could be the ones who move it forward and get it to the production level. We have to plan for that. if somehow someone comes along and something is interesting for shareholders and compelling for shareholders, we're for sure going to be open to it because we are shareholders, right? There's 20% of insiders own the equity of the company, so big stake in the game. So I think what really the plan is now is Barsley has a very obvious way to grow, and that's at depth below the deposit. It's really been only drilled to shallow depths for these styles of deposits that can go 1 kilometer, 2 kilometers pretty often, very often. In other parts of the world, and even in Sweden itself, and even in Finland, these deposits go deep. We're only at 500 meters. We're 2.5 million ounces only at 500 meters. If you get to 1 kilometer, you can pretty easily see that this thing can grow in multiples, right? 4.5, 5 million ounces is pretty straightforward way, just even to get to 1 kilometer. And then if it goes below that, it's all going to be gravy. So this is a decades long mine. It will be. I think the easiest thing to do right now is in parallel to moving it towards de-risking and moving it towards a construction decision. I think the resource growth is obvious and pretty straightforward. You're going to drill below the deposit, continue to show this deposit goes, and move it towards 4+ million ounces. And then, listen, even with 2.5 million ounces, you're there. You've got the number you need for this to be, a 15 to 20 year mine. But start moving towards 4 million, and then you start really adding some value. And it's all there. All the work's been done. So I think that's the way you grow this thing. You, in parallel, de-risk it, get engineering studies done, environmental studies done, permitting in parallel, start moving it towards a construction decision. And that's Barsley. And then, listen, guys, that 100 kilometers of ground around it, right? There's 2 to 3 more deposits in our belief, for sure. We already have 10 targets, probably growing. It keeps growing because we've only explored part of our entire land package, but we've got 10 targets that are just the size of Barsley already. 10. One of them is being drilled. Next one, we're going to move to the next one, and it's just going to be tested. And honestly, guys, if out of those 10, one of them works, done, right? It's gone.
That's all it takes, right?
Amazing.
That's all it takes, one. And what if I get 2 or 3? Then we're talking about a camp. We're talking about probably starting to talk about being considered on the global level of something significant. So, we're really excited, and I think we got multiple ways to move this forward because of the kind of staggered development stage of our assets. Barsley's most advanced. It's a mine. Let's go. And by the way, we've got all the ground around it, and let's go find some more Barsley-style deposits.
Excellent. I appreciate you laying out that vision. Now, before we run out of time, I know you guys have an active drill program. So just for anyone who wants to watch, to follow along, what are the next catalysts we can expect from the program and kind of some timing you're thinking on when you release stuff?
A super busy year this year. We started kind of drilling in March-ish. March was a little boggy and swampy. It's the 1 month that's a little things are slow because it was an unusually mild winter and it gets a little boggy. So we really started cracking into March, April. We are drilling at our most advanced target outside of Barsley. Remember, Barsley is fully carried. It's a joint venture, but fully carried by Agnico. They spend all the money on it. They're doing the work on it. But outside of that, the stuff that we 100% own, we've got our first IDA target, which we're drilling. Going to put anywhere between 7,000 to 8,000 meters in it. We're already well through that. So batches of holes are going to start coming out now. There was a bit of a delay in getting some of the assays back a couple of weeks because of some labs being shut down, and again the unusually mild winter. But it's all going to follow. It's just a few weeks behind. So steady stream over the next few months of drill results coming out to really start putting into perspective and painting the picture of what that target could be. IDA, and again, that's a 4 kilometer long target. Barsley sits on about 3 kilometers. So again, the potential is there. There is gold there. We've done all the prior work has taken years to get these targets ready, right? Geochemistry, geophysics, understanding the geology. That's all been done. So you got the IDA target. Then we're going to move the drill rig to our second most advanced target on our 100% owned ground called Nippes. That's north of Barsley. Drill that about 5,000 meters. So then those results will start to flow in the late summer, early fall. And then we've got another target, probably start October, November, called Harpsun, which is coming back now to south of Barsley. And then we'll start drilling that. And then the beauty of this, guys, is all these deposits, the geology is similar, right? So whatever we learn from the 30, 40 holes we put in one deposit, boom, we can start going, okay, we saw this there. What does this mean? then we move it to the next one, and it's all going to be. We're
point.
going to be able to learn from each one. And so like this year in total, we're aiming for about 20,000 meters, right? One of the bigger programs in space, the most this belt has ever seen, really, regionally, other than specific to the Varsity project. So it's going to be a year of discovery for sure on this belt.
Very exciting, Taj. Taj Singh, CEO of First Nordic Metals. Taj, thank you so much for your time. Always great to see the excitement you have around around all that's developing in the Nordics
and the crystal clear vision you have. It's refreshing. So thank you for laying that out.
Yeah, guys, if you need to, we'll have a link to First Nordic in the stream, and we'll also have these clips. But Taj, thank you so much for joining us.
Thanks, Taj.
Thank you, guys.
All right, take care. All right, everyone, Hard Money, another interesting company. We got a lot more to come. Don't go anywhere. We'll take a very quick break, and then we'll be right back. All right, everybody, welcome back to Grizzle Hard Money. The train keeps on rolling. As you know, it's a marathon, and we have another exciting guest coming up. We have the chairman of Rio 2. His name is Alex Black. We're going to bring him up in just a minute.
Alex, a pleasure to have you join us. Alex Black, Rio 2 chairman. Thank you very much.
Yeah, good to be here, and thanks for inviting me.
Oh, most welcome. And you know what? It's we all live on social media, and Rio 2 has been it's been one of those stocks that's been well covered on social media, and fantastic. It's been a fantastic run for the company. So congrats on all the success. It's been great watching. I wish we were invested, but it's been great to see it as a participant from the sidelines, so to speak. But congrats on all the success.
No, it's been an interesting ride. Obviously, we started off with this project back in 2018, and we hit some bumps along the way, and we sort of were put into purgatory there for a little while, and then we've come out of that in 2023, and here we are. So, and we like to utilize social media as much as we can to get our message out, to keep people up to date with what's going on. And I'm glad that I'm getting feedback from people like yourselves and others about the quality of what we're putting out there.
Yeah. So Alex, maybe just on those who aren't familiar with the Rio 2 story, maybe you could give us a little bit of the backstory, just to catch those up who haven't followed the stories closely.
Yeah, Rio 2 is focused on the Phoenix Gold Project in Chile. It's not something that we discovered. We're not geologists that go around the world discovering deposits of various commodities. This project was discovered back in 2010 and drilled between 2010 and 2014. It then sort of went on ice for a few years until we came along in 2018 and acquired the company that discovered the asset. That company was Atacama Pacific. It was a junior listed gold company. And we just looked at the project. We had built 2 similar mines in Peru back in the early 2010s to 2015. So it looked pretty analogous with what we had done before, and we thought, let's give this a go. And 2018, we were on our way doing EIA, etc., and then we got unfortunately held up by the new government in Chile in 2022. We went into a hiatus for nearly 18 months as they reviewed our EIA application, and finally they approved it in late 2023. We then financed the company last year. We did two key financings, and the second financing that we did in October fully funded the project with debt and equity, working in debt with Wheaton Precious Metals, so one of the biggest streamers in the world. Now we're building, and we're anticipating that first gold will be produced in probably late January next year.
Fantastic! Wow, that's great. Now I'm gonna get to your funding partner Wheaton. I had a question on that, but first, maybe I just wanted to follow up on kind of what makes your project unique, because it does have some very unique aspects that impact the economics I was seeing. Now that you have a great slide that I'm going to throw up from your deck comparing Phoenix to other gold mines. For anyone listening, could you just walk us through the key differences with your mine that make it unique?
Yeah, I mean, one thing about us being unique is that this is a run-of-mine gold oxide heap leach project, and there are not many of those in the world. And I can tell you that when we went through the financing process, obviously we worked with we reviewed proposals from other banks. It was very difficult. There's not a lot of experience in the world on these types of deposits, right? But we had built 2. As I said, La Reina and Shahuindo in our previous company, Rio Alto, back in 2010 and 2015. So we are very experienced at this. And as you can see from that slide on the screen, the only 2 similar run-of-mine gold oxide heap leach projects that I could find producing over 100,000 ounces in the world are those 2, both in Nevada, Marigold and Bald Mountain. And what we're doing at Phoenix is we're starting off with a small starter project at 20,000 tonnes a day, as you can see there for our ore mining rate. But we're going to be expanding that hopefully within the next 3 to 5 years to about 4 times the size. So when you compare that with the other guys, you can see that we're going to be much bigger than those projects once we get to the expanded state. But what you see here are some pretty interesting comparatives. If you look at, and one of the successes of this type of deposit, run-of-mine gold oxide heap leach, it's low grade, it's bulk tonnage, etc., is strip ratio, which is the ratio of waste to ore. And as you can see in those 2 projects, they've got 3.6, 2.5, and in our starter project we're at 0.85. So we're way below those 2. Our larger project is currently estimated to probably be in the order of 1.2. So that's still a lot lower than these 2 projects. The grades are very similar. The recoveries are very similar. And our projected AISC for the starter project is similar. Our AISC for the expanded project, once we do a study, which is being done and should be complete by the end of this year, we should see our AISC come down in our expanded project, probably closer to $1,000. So what I'm trying to get at is there's not many of these projects out there, but also ours will exceed the metrics of those 2 projects. And those 2 projects carry in excess of, I don't know what it is today because of the metal price, but probably close to $2 billion of value for each of those companies. And here we are, we're sitting there at just on 400 million US, and we've got a long way to go. So this has been a long story. It's not been a flip, invest and flip and trade. So I tell people that if you're looking for a long-term win on this thing, you have to be patient and watch us go through the initial construction, and then on to what we're doing with the expansion of the project.
Yeah, that strip ratio when I was looking really stuck out to me, so I wanted to address that. It seems like that's a
big key thing. Low grade, okay, half gram. Some people go, well, how do you make money out of half gram? It's virtually nothing. Well, you can, and we have in the past, so we know about this. But having a low strip ratio is another key factor. Having a good metallurgical parameters, and in our case, our projected metallurgical recovery is 75%. All good stuff when it comes to running one of these projects. And as you can see, with an AISC of $1,250, this project has never been a marginal project. It's not as though this project has come to the market because the gold price has gone up to $3,300. This project works at $1,500, right? So it's not and there are lots of projects out there, as you probably know, in the junior space that are all coming, to the surface now because of the metal price. This is not one of those. This doesn't depend on a high metal price, but obviously we're gonna benefit from it, and we're very happy to be in this position. But this is not a marginal project.
Alex, just with respect to your other two mines that you've done, maybe you could compare and contrast the strip ratio and the recovery of those compared to this one.
La Arena was probably one of the biggest successes in the world of any run-of-mine gold oxide heap leach project, and it was one that we built and operated until we sold the company. We sold Rio Alto to Tahoe Resources back in 2015. So La Arena, we started with a reserve of 860,000 ounces or something at La Arena. La Arena has just come to the end. It's now, or was recently, owned by Pan American, and they sold it to Zijin because there's a copper porphyry next to the oxide deposit there, which Zijin were interested in. And the overall reserve at La Arena ended up being close to 3.5 million ounces. That was how much gold was put on the pad. And at the end of the day, the head grade was about 0.32, right?
Oh, wow.
Very, very low. The cutoff was less than 0.1. And you can do all that when you've got low strip ratio, when you've got good metallurgical recovery. So that's a great example of how you can make money out of these types of deposits.
And what was the strip ratio on that one?
I can't. I'm trying to remember. And
yeah.
Was
it closer to what you have currently, or those two other mines?
I think when we started off, because same thing, we were mining the top of a hill. And in Chile, we're mining an extinct volcano, so peaks of the volcano. I think the strip ratio initial stages was around 1-to-1, very low, and I think as it progressed, obviously it got a little bit more. But when you've got a cutoff grade of less than 0.1, you're mining just about everything and putting it on the pad. And at La Arena, the recoveries were around 85%, which was pretty well unheard of anywhere in the world. I mean, we've got 75 where we are, and you can see the other two on that chart were around 75. So 85 was a bit of an anomaly in the world as far as recovery rates were concerned. So it was a beautiful success. We've put together the same team that built those two mines. I'm calling you from Lima, Peru. That's where I live. I've been here 25 years in Lima, and the team's here in our office. We've got a team of about 15 people. We don't have a head office in Canada. We have our CFO living in Vancouver and accounting support staff, but we don't have a nice glitzy head office in Toronto or Vancouver. We keep our G&A down. We've got a great team here, and we've got about 1,400 people in Chile on the project, spread amongst ourselves and our various contractors that we have building the project.
Fantastic.
All right. Now, I just wanted to move on to the funding. So you guys are fully funded. You partnered with Wheaton Precious Metals as your main partner. Just curious, what made you decide to work with them so closely to finance construction of Phoenix? What did they offer that you really liked?
Well, we already had a gold stream with Wheaton Precious Metals that we took down in 2021. It was a stream in exchange for $50 million of cash. And we had drawn down on 25 million of that cash back in 2021, and then we just drew down on the other 25 a few months ago. Because they were already under the tent, they knew the project, they knew us, etc. And when we went through the financing process, we obviously had offers of financing from other groups, but because of intercreditor relationships and guarantees and all this sort of stuff, we had to go back to Wheaton and say, hey, we're looking at these sorts of loan offers, and they just came back to us and said, well, why don't we do it? And typically Wheaton don't lend; they do streams, and that's what we said to them. We said, we didn't include you because you don't lend money. And they said, well, what can we do? We can extend the stream. And we said, no, we don't want the stream to be extended. We think it's sufficient in size. But then we said, what about doing a gold prepay, which means you give us money now and we give you ounces in the future. And they said, yeah, that sounds great. And it was the first, in our case, the first gold prepay that Wheaton Precious Metals had it done with anybody anywhere in the world. So that's a serial number one scenario, and we're happy to work with Wheaton, and they're great partners.
That's the beauty of having someone in your, as you said, under your tent already. You can get creative with the funding.
Exactly. And
now,
that's great.
Go ahead, finish that thought.
No, that's fine. I'm fine.
Yeah.
Now, Alex, just before we run out of time, I really wanted to touch on the remaining key construction milestones and timing before you see first gold pour for anyone who wants to follow along and make sure and watch what's really going to move the needle.
Well, I suggest that people just keep watching, Rio 2, myself, and because I'm on Twitter as well. Watch Rio 2, watch our posts that we put on social media, not only in Twitter, but also on Facebook and Instagram and other places. We're going to put out regular weekly to bi-weekly sort of videos and pics on social media. We'll be putting out quarterly updates. Our next quarterly update will be in July, which will summarize activities of quarter two. What I can say to people is we're tracking on budget and on time. This project is going really well. We are guiding that we produce first gold in January of next year, and we're on track to do that. In fact, we're putting up a video today on social media that'll give people a good view of what we've been doing. We're getting ready for winter. We've just about completed all the civil construction work, pad, leach pond, etc., that we needed to do before winter. And now we've built our shed, which encloses our processing plant, and that's where all the activity will be over the winter period. Winter period sort of finishes around October, and then in October, November, we'll be stacking ore on the pad and starting to leach, and as I say, first gold in January of next year.
Well, I mean, you mentioned that there were more ups and downs in your story than you expected going in, but it's better to be lucky than good. Now you're going to first production with gold at all-time highs, so it all worked out in the end.
Yeah, we were in the wrong place at the wrong time for a period of time there, but now we're in the right place at the right time, so I'll take that. And yeah, I mean, look, we're only a handful. I mean, there's only a handful of guys coming on stream in the next couple of years, gold producers, and we're one of them. So it's great to be in that window.
Excellent. Well, Alex, it was great to hear from you. We're definitely going to be following the story. I mean, it looks like you have a lot of catalysts coming down the line. So thank you for stopping by. That was Alex Black. He's from Rio 2.
Chairman C at Rio 2.
Yeah.
Thank you.
Thanks, guys.
All right, guys, hard money. Keep on going. Can't stop, won't stop. We're going to have a lot more good guests for you, some very useful insights, so don't go anywhere.
I met her there down the street.
All right, everyone, hard money. Here we go. Let's keep on going. Our next guest is one of the smartest macro thinkers on Twitter and in markets in general. So we always love talking to him. We're going to bring up Bob Elliot, CIO of Unlimited Funds. Let's bring him up. Bob, welcome back to Hard Money. How are you?
Hey, Bob.
Thanks so much for having me. It's
always
anything
been
going on
Bob.
Since the last time we talked.
It's a few things have changed. Maybe nothing at all. Who knows?
One thing that has happened for sure is we all have more gray hair. That is for sure.
That's true.
You could confirm that fact.
Oh, yes. Bob, it's what a time to be a macro investor. It's just vol on high, incredible 2025, and but it's really highlighting to be a year of hard money, right? Like if you could typify that, right?
Yeah, that's for sure. I mean, we've talked, I guess, for a few years now about how the world is waking up to the value of hard money and the need to diversify into hard money assets. And man, if there's a year that epitomizes that more than any, it's this year, right? Gold making new highs, Bitcoin making highs. I mean, it is some of the silver surging at various times. I mean, it really is about people looking for assets that are outside of traditional stocks and bonds in order to protect themselves from this mess that we face right now.
Yeah. No, Bob, I love getting your take on Bitcoin, but first, I wanted to continue on that topic. I'm just curious what you think of Trump's tariff policies. However it ends up, do you think kind of the cat is out of the bag where other countries are realizing there is a risk to owning dollars and being as reliant on the U.S.? So maybe at the margin, do you think we're moving away from the dollar and U.S. treasuries over time? Who knows what the timeline is, but kind of has Trump reignited people's risk aversion to maybe going all in on America?
Yeah, well, I think that the going all in on America point is, I think, an important one, which is it's not that people were sort of balanced in their diversification, global investors balanced in their diversification to the U.S. They were way overweight U.S. assets, whether it's way overweight U.S. bonds or overweight U.S. equities in particular in the last decade or so. And so I think what we've seen is much more those institutional investors saying, hey, wait a minute, it doesn't necessarily make sense to be all in only on the U.S. and on U.S. exceptionalism and the U.S. dollar. And so the challenge for the U.S. is just even this reversal in that flow, right? From what was for almost a decade, the U.S. getting 70 cents of every incremental dollar invested in global financial assets. If that comes back to 50%, that's still a drag on particularly the dollar, and it's a drag on U.S. asset prices. And that's not a particularly extreme shift. It's not like, central banks dumping money in the streets or global pension funds totally getting out of U.S. assets. It's just rationalizing a more, let's say, reasonable or neutral position on U.S. assets relative to what we've seen before.
Yeah, that's a good way to describe it. Everyone likes to talk death of the dollar. That's more hyperbole. This is maybe what's going on. It could just move back to a normal range, and it still will have an impact.
Yeah, that's exactly right. It's no longer all in on the dollar. That's what's going on. And I think from a hard money perspective, I think one of the things, a lot of people focus on the dollar as, the real focus of people getting out of what people are getting out of. But the reality is, if you look across the world, investors are getting out of fiat just across the board, right? And so, for instance, we talk about the fact that gold's up in dollars, right? All the time, people quote that, but gold's also up in yen and in pounds and in Swiss francs and in every currency you could basically imagine. And so so you sort of have two dynamics that are often conflated with each other that are not actually necessarily exactly the same, which is diversifying out of U.S. assets and coming back to sort of more normal allocation to U.S. assets, and two, moving away from fiat assets and bonds and things like that, and moving towards hard assets like gold and Bitcoin.
Bob, maybe just a question on that. We've basically seen this, move away from fiat across the board. Have we seen periods of like this before where, say you don't have a strong pound or a strong USD or, like where all of them have been, we're kind of done with this paper stuff. Like, have we experienced that as a regime as yet?
Yeah, I think probably the closest regime to that was another period where the world was too globally indebted, and that was in the 20s. And essentially what you had is you had a situation where there was a recognition that essentially paper money had to be devalued relative to hard money in order to deal with the overhang, the debt problem, the big debt problem. And so I think it can be confusing because people think about breaking off the gold standard during that time frame. But another way to think about it is when highly indebted, what the choice was to devalue paper money relative to hard assets. And that's essentially the way that it was dealt. Now, of course, here we're not sort of facing a depression by any stretch. The economy's mostly fine. But that dynamic of, I think that recognition that the end game is pretty clear. The end game is that there's going to be bad returns, real returns in bonds. There's going to be a devaluation of currencies relative to stuff. Like that end game is increasingly recognized, and then people are, just honestly incrementally moving their capital in that direction. There's a lot more that could be done there.
Right. Okay, I want to get in a quick Bitcoin question. What I love is that we've now been talking about Bitcoin, your opinion on it, for I think over 2 years. And it's funny, I'd say I characterize it as you've been warming up a little bit, but you are a pragmatist on the whole thing. So I just wanted to check in and get your latest take on where does Bitcoin fit in investors' portfolio? Have you changed your mind since we spoke? That was like 9 months ago or something like that.
Yeah. I mean, I think, in general, my picture hasn't changed, which is you're sort of seeing this intersection of an asset that is a risk asset, a speculative risk asset, with an asset that is a contra currency asset. And it's almost, I actually enjoy every morning sort of looking at the market action and kind of thinking like which one of those two aspects in the tussle is sort of winning out, right? And if I look over the course of this year, the speculative aspect has been a bit more of a winner in terms of the tussle. Certainly in sort of shorter term movements. Obviously, we saw some real weakness around Liberation Day, which was a period when gold actually held up quite well, right? And so that kind of that highlighted the risk asset nature of Bitcoin. But if you took a step back and you just said what's happened to Bitcoin over the course of the last couple of years, it actually doesn't look all that much different from gold in terms of doubling plus, right? Kind of a slightly higher beta than gold. And so in that sense, I think it's still a little bit of both. I'm maybe because I'm a Luddite and old school macro guy, still, I'll still talk about gold. I think I see gold in this display here, though. So, it's not totally out of what you guys talk about.
Yeah. Bob, maybe, I would love to get your thoughts on just what, the Bitcoin ETFs and, just a prolific AUM gathering there.
Yeah.
Just maybe your thoughts post game summary. And, we just found out earlier this morning that they just did another 9 billion over the last few weeks, right? It's this train is incredible. And that was James Seyffart who gave us that data point. But you would love to get your thoughts on a post analysis of how material that this ramp up of like 12 different ETFs getting to scale and size.
Yeah, to price and volatility of Bitcoin potentially.
Yeah, well, I think the first thing I'd say is it just highlights like how valuable the ETF infrastructure is for the retail investor and the RIA investor, and it's not just the ease of execution, but it's also the explicit and implicit protections that exist in that wrapper. And so I'm sure lots of folks who are engaged with your content like wrestle with, do you want to hold the keys or not hold the keys and things like that in terms of their crypto investments. And I think what the ETFs are showing is while it may be one step removed from the physical asset, there's just so much value in the ETF infrastructure. In the same way, it's hard to believe, but like 25 years ago, you could not invest in gold through an ETF, right? If you wanted to buy gold, I remember when I started my career, if you wanted to buy gold, I mean, it was literally like go down to the guy who sold gold in the strip mall and buy some coins, right? And and the ETF world revolutionized investing in gold in a way that I think a lot of ways you shouldn't really think about gold as, there's sort of pre-ETF and post-ETF when you think about gold. In the same way, you should probably think about the same Bitcoin the same exact way. And the thing that has surprised me a little bit is I'm surprised actually there hasn't been more price pressure given the magnitude of the flows through the ETF channel that we've seen so far, which does suggest that there's some on the other side who are basically taking profits in this, given the flow. I'm not that close to the actual flows, but that's the question that's kind of in my mind, which is like, why doesn't it feel like there's more of a squeeze going on as a result of all those flows?
But Bob, the way you frame that up is so good. Like, it just really is like, this is really a story about the power of the wrapper, the ETF wrapper. And it's just, and, like you brought up a good point about, GLD and, how but I've been covering gold equities for a very long time. And I would say the advent of the GLD, the way you'd kind of invest in a more ease of way of getting into gold is you'd go buy gold miners. But then the ETF took away that, like the gold miners have had a detrimental impact because of the ease of the ETF.
Right. And in the same way, I don't know if you invest in Coinbase or something like that, you have to deal with, like, who knows, all the idiosyncratic issues related to Coinbase, which, is it like generally indicative of what's going on in the crypto world? Like, sure. But is it, could they do all sorts of, could they have an FTX moment? I mean, I'm not saying they are. I'm just saying, like, you have that single company idiosyncrasy that you're sensitive to in a way that when you buy the ETF that holds the asset, you have much less of that sensitivity. And so it's just for investors, it's just a better deal for those who want exposure to the asset itself.
Yeah.
All right. Now, Bob, I wanted to get your overall thoughts because you put out some great macro work just on the puts and takes of what's going on with tariffs and everything like that. It's a very pragmatic, data-driven view. What do you think is currently priced into asset markets? You look at interest rate policy, tariff policy. How do you see upside versus downside in the market balanced at this moment? I think things could change in an hour, but I'll throw it to you.
Based on a tweet, everything could change.
One tweet away.
One tweet or some bombing of Iran, and we'll see.
Right.
The basic picture I'd say is I think there was a real question from this new administration whether they were going to pursue sort of a conservative, sort of almost like a fiscal conservative path in their coalition, and they're going to prioritize that, or they were going to prioritize, the run it hot coalition, let's say, of their constituency. And I think what we're getting a meld of the two, which is actually, I think, kind of confusing people, which is high tariffs expected to be there for a long time with some stimulation that is coming through the big, beautiful bill and various activities there. And I think the important thing for investors is the timeframes of those two things are mismatched. And it's really important from a macro perspective because the tariffs are hitting today. We basically had a 1.5% of GDP tax that, is today. And that has a drag on economic activity today. The big, beautiful bill really has an impact supporting growth modestly in 2026, 27, 28. And so that mismatch, I think, is going to be challenging because we could easily see a weakening of economic conditions in the near term as that growth negative policy hits the economy today, even though you might get some offsets in the future. And things like stocks and bonds they really are priced for, clear sailing, basically. They're really like very much in the running hot side,
or they're just not prepared.
Exactly. And they may be looking through, which I think is probably not what's happening because stocks mostly trade on like what growth over the next 6 months or something like that. So my guess is more they're not sufficiently reflecting the challenges in economic conditions given the policy mix that's happening. And I should also say, and the sort of gradual natural slowing that we've seen in the economy in the last couple of years.
Okay. Yeah. So you've become more cautious as asset prices have rebounded from the April lows.
Right. Exactly. And I think it's interesting if you look at how like macro hedge funds are positioned, their biggest position tactically is actually long bonds, which is interesting, and long gold, right? Long bonds, long gold, and short the dollar. That's kind of their most tactical position. That's a pretty growth negative set of positions that they're essentially holding, reflecting the fact that maybe assets have gotten a little too excited about run it hot here.
Yeah. Right. Now, Bob, you run a really interesting ETF issuer doing some stuff no one else is doing. So I wanted to talk about that a bit. You've been launching a suite of ETFs that track private hedge fund strategies. Can you briefly explain the exposure you're offering investors and why you've mentioned you like the ETF wrapper? Why is that a better fit for everyone? And then I'd love to dive into some of the trends you're seeing and how these hedge funds are behaving lately.
Yeah. So I started Unlimited basically having been in the hedge fund business for a long time, with the goal of bringing hedge fund returns to every investor, whether you got $20 or $20 million, that you should be able to get access to those returns. And we started a product a few years ago, which is kind of like HFND is the ETF. It's kind of like the SPY for hedge funds, meaning like it's basically an index tracker. What's really exciting is we've taken having proved that we can track how hedge funds are positioned in an ETF wrapper. We're now taking that understanding and launching a series of new products. Probably the most interesting of which right now is a global macro strategy, a global macro tracking fund. And we're doing it in a way that targets 2x the returns of what hedge funds are typically targeting. So you get that sort of low correlation benefit from that macro positioning, but with a high target return, that is, I think, pretty attractive for a lot of investors, particularly for those looking for diversification relative to just like equity risk.
Right. Yeah. And it's just an easy vehicle with liquidity and everything. You just pick the ticker versus what you'd have to go through to create those exposures in the past.
Exactly. Like if you want to manage, 30 or 40 futures contracts exposures in your own PA and tactically manage those on, a day-to-day basis, like go for it. But I'll tell you, I certainly am relieved to have an ETF that can do that all in one wrapper.
Yeah. No, it's a very, very cool products. We're looking forward to. I know you're planning on launching 2 additional ones on top of that. Could you just tell us, based on what you're tracking, what have hedge funds been doing lately? Like, what's their positioning? What do they like? What do they not like? What are you seeing that's interesting?
Yeah, I mean, I touched on it a little bit before, but I think the thing that's probably the most interesting is despite the sort of rebound in stocks. And frankly, rise in bond yields. Hedge funds have now shifted to fading those positions to some extent, going really non-consensus long bonds on expectations of some disinflation and lower growth printing. Again, this is very tactical rather than sort of a strategic view. It's very tactical view, and continuing to hold gold. And it's pretty interesting, like the combination of these positions. If you look over the last couple of months since we've had our macro ETF launched, it's up 7.5% with a 0.2 beta to stocks. So, that mix of positions, it's working. And it's, even without taking on equity risks, it's been a nice diversifier.
Great. Bob, this has been a great conversation. We always love having you join us. Thanks for giving us some of your time, and we wish you all the success in the world with your fund launches.
Great. Thanks so much, guys. Really appreciate it.
Bob, thank you.
All right. Thanks, Bob.
Always insightful, man. Bob is a great way of bringing contextualizing concepts, like just around the Bitcoin ETF, right? It really is a story around the wrapper, man. It really is that it's just incredible stuff.
Yeah, it just shows how important ETFs are now in asset prices. You got to watch what's going on in that land.
Yeah.
All right, everyone. Hard money. We're not done yet. We're going to take a very quick break, and then we'll be back with our next guest. Don't go anywhere. All right, everyone, welcome back. We hope you've been enjoying. Remember, any comments, questions you have, put them in the chat. We'll respond if we can, and hope you enjoyed that last guest. Bob is great.
Oh guy. Yeah, we got a nice little setup here because we got the originals. Since we've been doing hard money, we've had a set of guests that have been providing incredible insight, and B, right. And we're gonna bring up one of those guys, Jeroen Blokland. Come on up. Jeroen, how are you? Thank you so much for joining Hard Money. I'm not sure, how many installments we've been all doing this together, but really appreciate you joining us. But further to my point on the intro, you have been long scarce assets, and I'll let you define them. For those in the audience who haven't heard you define what scarce assets are, but heck. That's been one heck of a great call, man. And congrats on the fund.
Hat tip to you.
Yeah, well done. Jeroen, why don't you tell our audience, what scarce assets are, the Blokland Fund, and a little bit of your, your philosophy and process for the fund.
Yeah, sure. Well, again, nice for having me. I think this is the third time, if I remember correctly.
It is the
third. You need a bit of luck when you introduce a new investment philosophy and a strategy. Well, maybe I should not call it luck anymore, but of course, things have been going great. On the funds philosophy, so the idea is very simple. I believe in multi-asset investing. I believe in diversification. I just don't believe in it in the traditional way, the 60-40 portfolio holding 40% of bonds. Now, I can show you a number of graphs that will show you that bonds, especially in real terms, have not delivered. So I had an event in the Netherlands here, and I showed the real return on Dutch bonds has been now negative since 2005. So for 20 years, no real return. And I think this will remain the case, because I think if you look at the world around you, it's built on debt. We need debt to keep growing. We buy debt. We buy GDP growth using debt. That means we structurally need, and Trump is a good example of that, low interest rates and high inflation, because that benefits people, companies, and governments that have high debts, and that does not really benefit your savings account, or if you're an investor in bonds only. So I still believe in the traditional way of investing, multi-asset diversification, just not with bonds. And given the, let's say, the environment that we are now investing in, with these big, massive budget deficits, piles of debts, low interest rates, and so on, I think you should invest in the opposite of what is abundant: money, debt, and bonds. And then you end up with things that you cannot print, that you cannot issue, that are special. And of course, then you end up with gold, Bitcoin, and also for us, quality stocks. You can also say stocks that are scarce, companies that are scarce, but everything that is not issuable, printable, or cannot be copied that easily in terms of a business model like that. And that is the simple philosophy. When debt is abundant, invest exact opposite.
Right, that makes a lot of sense.
Yeah, totally.
Now, you run a fund that owns both Bitcoin and gold, so I'd love to get your opinion. I think you've talked about this before. Why do both make sense in your portfolio? Why haven't you picked a side like a lot of people choose to do?
Now, the first thing is that I love diversification. And even though a lot of people think that it's totally the same or not the same or whatever, the correlation between the two asset classes, and also the correlation with the third asset class that we invest in, equities, is low. So that means at this point, it offers diversification benefits. But the thing, of course, is that gold has a history of 6,000 years being a monetary asset, the fundamental part on which of our financial system is built. You see that a lot of countries that do not like the dollar, but have a currency that nobody really wants, who wants to hold the Turkish lira, the only escape they have to get away from the dollar is to buy gold. And this is what you see every month when these publications pop up, that all of these emerging markets countries are buying gold again. The second is that we live in a digital world. Everything is digital. Debt is digital. Money is digital. And I also think that this could be a very cool time to open up to an extension of the monetary base in the digital space. Now, and I think there's only one candidate that could become that, and that is Bitcoin. Bitcoin, of course, in the digital space has some advantages over gold, because if you want to send it to the other part of the world, other side of the world, that's much easier than sending gold. And also, if you want to verify if that is a true transaction and you actually hold the value, in this case Bitcoin, that's even a little bit more straightforward than gold, because you have to melt down every now and then. So the one asset class, Bitcoin, I like for its potential to be digital gold. The other one I like because it is the true store of value in our financial system. And every country that wants to move away from the dollar hegemony has to go through gold first. At least that is what I believe, because I'm not really fond of holding the Chinese yuan yet instead of the dollar, for example. So these two asset classes do not bite and offer diversification benefits. So I own both.
And Jeroen, maybe your thoughts on just this bipolar world. Obviously, is that that's providing an acceleration of a gold adoption. Is that a fair take on how central banks are expressing that obviously as well?
Yes, I think that is a very good conclusion. If you look, for example, at China, China is, I think, the most vocal country in wanting to move away from the dollar. What is happening with the trade war now? Maybe they become friends in the short term, but I'm pretty sure that it will leave scars for the longer term. China has a official gold reserve of, let's say, 6 or 7%. It buys a lot of gold through unofficial way, so maybe it's 10 or even 15%, but it's no way to where it should be if you want to say, okay, just give me your currency, because I know that for every yuan there is some gold in some central bank account in China. So I don't know if 10% must become 50 or 80 or 90 before the Second World War. I do know that 10% is extremely low, and this is the second biggest economy in the world. So if China wants to move up to, let's say, 30 or 50, that's a huge leap from here. And that completely fits in this multipolar world where China is one pole and the United States likely is the other, right? So there's a long way to go if you believe that gold is the way out of the dollar, so to say. And interestingly, the ECB, so a Western bank, is putting more documents on gold. It's interesting. And also you see in their own publication, gold has now surpassed the euro in these regions. So Lagarde likes to talk about the euro and can it be the next world's reserve currency? No, it cannot. And gold is already ahead of it. So that's yeah. So don't count on it for the euro. I'm sorry to become the next world's reserve currency. I do like vision, of course, but gold is actually published by an ECB paper already ahead of the euro, and this will continue. Is my expectation.
It's a great dovetail. The one point Bob had brought up is this is not gold appreciating relative to the US dollar. This is gold appreciating relative to fiat.
Yeah, this is the one thing is you can print fiat currencies until oblivion. And if you believe that we are in this situation called fiscal dominance, which is now becoming very popular, that fiscal policies push out original central bank policies, meaning inflation targets and things like that. It's now more about monetizing debt. You have to print money because you have to actually to buy these bonds and this debt. And this is something that is global. It's not just like. In fact, I think in the end, as they call it, that the dollar is the cleanest shirt in the dirty laundry, and the euro is much dirtier. And so this is a diversifying away from every currency out there. China has to, and nobody wants the euro. So yeah, that is, and I think every time you see data, it's so extremely obvious. You don't need any downbeat view of the world that everything is going to collapse. This is what's happening. So we want to get away from the dollar-centric system. Okay, that requires more gold in the entire system. It's as easy as that. I think so. Yeah.
So, Jeroen, you're well positioned to, and we've always leaned on you for your thoughts on Europe. Maybe you can give us an update, state of the land. Obviously, bearish on the euro, but the construct of Europe, especially in the context of Trump and America, moving in an opposite direction. I just wanted to get your thoughts on a military. There's so many areas where Europe is going to have to spend more money. And does that just accelerate the euro's decline? And just, is there a way out for Europe to be more productive and be a great industrious continent?
Of course there is. So a lot of the lag in Europe has to do with regulation. Let's start there. We are entirely, completely overregulated. And every time a country like mine, the Netherlands, has a great idea on some issue, for example, housing, there is somebody from Brussels looking down and saying, "Oh, you cannot do that on your own. You have to wait for legislation to fit all of these countries, even though you are very different than all of the other countries." So legislation, regulation, please get rid of it because it hampers. Second is, of course, that and the whole climate debate makes things worse. So these are unrealistic targets. So I like realistic targets, but if they are unrealistic targets, you have no goals to realize, and second, you have offered all other important aspects of society and the economy as well. Having said that, Europe has been a little bit lazy, of course. So yeah, I think also if you look at the speed of aging here, it was very favorable to have the United States doing most of the spending, most of the fighting and things like that, because that covered up this idea that this aging society, especially in a welfare state, is at some point it will break down, or it has to adjust. Let's put it that way. And an interesting example is, of course, France. They have been fighting for months. Their government broke down again, and even then they realized to put in writing that they aim to have a budget deficit close to 3%, but not sure if it's going to happen in 2029. I'm going to tell you that is never going to happen. They won't unless we give up the welfare state. So right. The way out for Europe is let productivity, innovation at least get a chance. So this is something. The defense spending is now mandatory. That's also funny. Defense spending is always categorized as being discretionary, but it's not. It's mandatory. So that immediately in Europe puts 3% of the budget, 3% of GDP per year in additional cost. And there's no. So in the Netherlands, they're already fighting how to solve that because and even the Netherlands has a low debt and low budget deficit, right? So it'd be possible here. So we are not lost, but we are way behind. And the only thing is to understand that we do not rule the world anymore, and we should adjust or accept that we get smaller and smaller. And that is the big discussion that is now going on here. And of course, I'm for the first, but a lot of people think differently. So it's difficult, but it's not possible for us to matter still.
Yeah, because the alternative is that Europe, just becomes a place where people kind of see history, come and visit for tourism, and like that, and like
a museum,
yeah,
right?
a museum.
You don't want to be a museum.
Yeah, you don't want that. It's just, but it's that regulatory, almost that regulatory championing. They love this stuff. They love the red tape. They love just wrapping up ideas and making them go nowhere.
Yeah. Now, and a good example is, of course, the big tech companies. They thrived in the United States and also outside. And in Europe, they have this massive amount of regulation as well, and privacy things and all these things. So their growth here is always slower. The result is, of course, that also in the technology department, except for the Dutch ASML, we are way behind. So this is also something. Do you want to embrace it? So when Mr. Draghi writes a report saying technology is the way to go, and you say no, then he said, I don't know if you watched that clip, you cannot say no to everything. That's really true. We say no to everything. So let go of some of them. Yeah. And of course, we can also choose to be a museum for one part, because there are a lot of countries in the world, not just in Europe, that have a very big tourist sector. That's fine by me. So I don't think that we should necessarily say that is a bad thing. But we lack the ambition to also grow in other departments, technology being one of the biggest examples. And I think if you get rid of all these barriers,
it's interesting you bring up technology, because arguably, I'm based in Canada, Scots American, and I see Europe. Trump has created a bit of an opening here on the visa side, where you have some great technological minds that are looking for where it would be harder to get across to America. But I do not see Canada, I do not see any of the countries in Europe putting up their hand and saying, hey, let's create an economic tax-free zone. Let's do stuff.
Hey, you got a good idea? Come here.
No, it just, there isn't that entrepreneurial spirit which has driven the Valley, which has made America so successful, that when you have a clear opportunity, like I was even saying, with people talking about tourism, Canada could be the second best America, right? And I'm like, why has Canada not plastered European TV with "Come to Canada"? We're so dumb. We can't even do that sort of stuff. And I know the same thing would happen in Europe to not do this stuff. This is I just sometimes just see one country and one country alone, and that's America. That's thinking forward.
Yeah, I totally agree with you. This is an excellent point. The door is now wide open for a lot of smart minds wanting to leave the United States. If that's logical or not, that's a different discussion. But yes, and this is also not to mention the Dutch company ASML again. But every now and then, every quarter, they come up with a news aimed at the government. Okay, forget about this whole mass immigration thing. Think about immigration. We need smart people. There are not enough Dutch people to fill our capacity, our plans and things like that. And we want to expand. So the Dutch government, and that's also for all the other countries, we should think about, is this the possibility to build a second ASML? And I missed it. And I am completely, if something breaks on the other side of the Atlantic, you have to be ready to absorb everything that you like. But this is also the polarized version of immigration. It's either you are fully in favor of it, and then it means mass immigration. And if you say no, then you're a racist or whatever. So what is in between? Immigration, per definition, in aging society, is a very good thing. You have to be smart about it. That's a different thing. But yeah, so I agree about Canada, but also in Europe, this should be a time. This is why I like, they won't make it, but I like the action by Lagarde. Should we discuss the euro as the world's reserve currency? At least they discussed it. So they will make it. That's better than doing nothing. Yeah. It's better than doing nothing. It's better than doing nothing. So I completely agree with you. We are not street smart.
Like, did you know the CEO of Perplexity, which arguably one of the great AI apps, he still does not. He's still on some sort of like not green card, like it's some H-1B, whatever. So you got one of the great, like, why is the Netherlands or France or England not saying, hey, come here, we'll give you another 50 million, and you'll get English citizenship or EU citizenship. Do something.
Yeah. It seems very logical. Yeah, on paper.
on paper. Right? That's the.
Here now, there's one chart I really want to catch up with you on, which was your inflation then and now chart.
Yeah.
We've had a lot of things happen on geopolitics. So based on what's been happening lately, I mean, do you feel more or less comfortable that history could repeat on the inflation front? And I'll throw that up for anyone who's watching.
Yeah. Well, of course, you cannot forecast the characteristic of the tariff war.
Sorry, wrong chart.
Yeah, this is the other one. Yeah.
You'll recognize. You're like, I didn't make that.
Yeah. Is it coming, or otherwise we just continue talking?
Yeah, there we go. There we go.
Yeah. So this chart, so it compares the inflation spikes of the 70s and the early 80s for totally different reasons. But my story always here is I cannot predict if this is going to happen. I do know because of the multipolar world in combination of the need for debt monetization by central banks, the odds of this happening again are much, much higher than is anticipated. And the simple reason, and again, sometimes it's so easy. The simple reason is that if you think that this is possible, even if it's a 5 or 10% chance, that would mean that a lot of people would have to reshuffle, would have to reorganize their portfolios, because bonds and savings and all of these things that are very sensitive to inflation, they won't help you in retaining or growing purchasing power, which is the ultimate goal of investing, of course. So my idea with this is, I'm not saying that it will happen, and especially again inflation levels of 10% and higher, but I do think that people should get used to the idea that every now and then inflation is going to spike, and that on average means that inflation will be 3% or even higher, I don't know, and that you should prepare for that by rearranging, as I mentioned, your investments. And since the traditional world is not moving one bit, I can tell you, away from the 60-40 ID, this is going to be a shocker that now it's 20 years that bonds have not provided any pension return, investment return, diversification return, multi-asset, whatever, that it could be 10 years from here, because every day that and in America that's a little bit different, but here in Europe, and especially in the Netherlands, interest rates are well below inflation rates. So every day that this stays like this, your real return on bonds goes down. And this is, as mentioned, I showed a chart earlier, but we should start thinking about real returns more. This is the only thing that makes you more wealthy. That shows you if you have actually made a positive return on your investment. It doesn't matter if you realize a % return when your groceries are rising by 10% a year. So what's the point then? So that is the idea of the chart. Take into account that inflation risks are significantly higher than they have been, and that you are used to be in a very benign environment, also politically, and this is going to change. So that is the idea of the chart.
Yeah, it's a smart concept. The probability may be on the low side of this happening, but it would have very important ramifications. So it's worth preparing for. Is the bottom line.
Yeah. I don't understand why a sound investor holding 60% in equities and 40% in bonds would not have even 5% of his assets outside this traditional financial system, into inflation hedging assets, geopolitical sensitive assets, whatever angle you take. And also, if you look at how traditional investors build their portfolio using various optimizations, you cannot, with the actual data, get away with a 0% allocation toward gold, for instance. So you are now looking at 40 years, 50 years of data where gold on a real sharp ratio basis is better than bonds. So how do you not incorporate that into your portfolio? I do.
Yeah.
Right. That's smart. Now, before we end things off, I just wanted to talk a little bit about your fund. So it's the Blokland Smart Multi-Asset Fund. Could you just, for anyone who's not familiar, just talk about what the strategy is and what the allocation looks like?
Yeah, sure. So it's an investment fund that only invests in scarce assets, and there are three core holdings, which are quality stocks. This is a specific set of equities within the investment universe that scores high on three basic criteria. The first is they have structural competitive advantages. They have low debt, of course, because I don't like that. And they have relatively stable earnings. So if there's a recession, your earnings won't melt away immediately and dividends are still paid and things like that. The second is physical. So that's roughly 60% of the portfolio, because I like diversification, just not the traditional way, 60-40, but the equity part I like. And then the other parts of the portfolio, 25%, roughly is in physical gold. So in a vault in Switzerland, not paper gold, not ETF gold, physical gold. I've seen it this year. I went there. It was not romantic at all, but I've seen it. And it's not James Bond like at all. So
it can be all shiny.
No, they don't build it up for you. It's just like, because it's also scattered and they have to find it. It's very hard work for them, and they don't like it when you come. But yeah, they understand you have to audit it, of course. But no romantic part in that. And then the smallest part of the portfolio is in Bitcoin, and this has to do with the volatility of Bitcoin, because the nice thing about Bitcoin is it has a low correlation, but that also means that you one-on-one you get the volatility on board, and we want to have a balanced risk profile that compares to the traditional 60-40 portfolio. And these three assets we combine in such a way that the risk-return dynamics are much better than the traditional 60-40, but with the same risk profile, because most people in the end up being a balanced investor. They don't like big drawdowns, and they also don't like very low returns. So you end up somewhere in the middle. This is also my angle that more and more I want to get into in the traditional asset management world where I originally came from. And you see also some things happening, that some of these traditional investors to a fund platform that we are now on actually invest part of their clients' money in the fund. So they see it as a satellite approach. So that is basically it. We invest in scarce assets and nothing else, to move away from highly sensitive, interest rate sensitive and inflation sensitive assets that are abundant, like bonds.
Makes a lot of sense.
Jeroen, the way you lay it out, it just to Scott's point, makes a ton of sense. It's been the right asset allocation. Congrats, and Jeroen, thank you so much for always holding it down for us in hard money. Thank you so much. That's the Blokland Fund, Jeroen Blokland. Thank you so much.
Thank you.
Thank you, guys. Okay, have a good one.
Thank you.
All right, man. Another amazing guest with these insights. I'm going to watch this all back because I need to make sure I took it all in. But everyone, all right, we're going to take a quick break here to regroup, and then we'll be right back with more hard money. All right, everyone, welcome back to Hard Money. Hope you've been enjoying all these insights and speakers. The train keeps rolling, and we have a very special friend of Grizzle back again. He always has the sound bites in Hard Money. It's Leigh Goehring. He's a principal at Goehring and Rozencwajg Associates. Always has some great thoughts across the commodity spectrum. So we're going to bring him on and have a conversation.
Leigh, how are you?
Very, very good, guys. And thank you so much for inviting me back to speak. I love dealing with you guys, and I love participating in your programs.
Well, thank you so much, Leigh. Always a pleasure. And you've been here since day one, and you know, a long forging friendship with our partner Chris Wood, and so we're always thrilled to catch up with you, Leigh. Thank you so much for joining.
I love being here, so thank you for having me.
Got to let you kick off.
Leigh, I want to give a hat tip to you because we had you on at Hard Money 2024. For anyone who's listening now, I hope you were listening in 2024. He was telling listeners to buy gold at our commodity. Actually, it was at the commodity conference, but he's been at Hard Money as well. So that was last year. What's happened since then? Gold is up 30%, and the miners are up even more. So I wanted to follow up with you. How does the risk reward look to you over the next 1 to 2 years, given where geopolitics and interest rate policy sits today? A little catch up.
From the underlying fundamental situation and geopolitical situation, things are only going to get more favorable for gold going forward. Obviously, you know, Trump is trying to rearrange or undermine, depending on what type of verb or adjective you want to use, to the whole global monetary system and the whole geopolitical system. When you think about it, trying to do that in a very short time period is going to be very, very destabilizing, and that's what that's what we're seeing, both from the geopolitical standpoint and from the global monetary standpoint. So that's why central banks have become voracious consumers of gold. You know, for the third year in a row, they bought over 1,000 tons of gold, and this year they're lagging slightly versus last year's pace, but I suspect this will be the fourth year in a row that they're buying physical gold in huge amounts. So that's one very, very positive thing, and chances are that's probably going to increase going forward, given the fact that there is, you know, we've talked about it before in the show, there is a huge monetary regime about to take place, and what form that takes we really don't know, but it's going to involve devaluation of the US dollar, just like every other monetary regime change that's happened over the last 120 years. And the way a central bank or a foreign country protects themselves against that is to get out of dollars and something else, and that is going to be gold. And I think that's what we're seeing in the gold market today regarding the central bank interest. Now, what's interesting too is that central banks now have returned as big buyers of gold, but the Western investor is now turned back into a gold buyer. You know, after shedding, you know, close to 1,000 tons of gold between the summer of 2020 and the first quarter of 2024, the Western buyer is turned back. Western gold investor is turned back into a buyer. And so the thing is that, you know, that means that not only do you have central banks buying, but you have the Western investor as well. And so you have two very strong sources of gold demand that I can't foresee lessening at all in the next couple of years going forward. So that's by far the most important underlying fundamental reasons from a demand perspective. But this is I think the most important thing for a gold market investor today is that the average Western investor has not he's accumulating physical gold, started to, but what's interesting is the average Western investor, especially the equity investor, has no interest whatsoever in gold shares. In fact, you know, if you track the open interest or the number of shares outstanding in the GDX gold stock ETF, the Van Eck gold stock ETF, since gold broke out in the first quarter of 2000, that's exactly it. Since it broke out in the first quarter of 2024, the open interest in that ETF has fallen by almost 30%. As what's interesting, as the gold price goes higher and higher, the the person that might be a gold stock and buyer is actually still a seller. And you could make the case that the entire move in gold stocks over the last year and a half, and I think, as you mentioned, I think they're up like 45% or something like that, almost 50%. The entire move is basically short covering. There's no been real buying.
Wow.
So this is what's so interesting. What that chart, that GDX chart, is telling you that people haven't at all bought into this gold bull market. And so now, if the open interest or the number of shares outstanding in the GDX were exploding, which they're going to someday, and the gold price was moving up sharply, I would say, hey, look, guys, you probably missed a good part of this gold move. And I would say, well, the gold could still go up, but the bulk of the move, you've missed it already. However, just looking at that chart, it hasn't even started. In fact, people are still fighting it. And you guys probably talked to some gold, so pure gold funds, mutual funds and things like that. And what are they seeing? Other than the last couple of months, they've seen nothing but redemptions. And that's what that open interest that GDX is showing is, when they get redeemed, they have to sell their stocks. They sell to some big trading desk, and the trading desk basically shorts the GDX against their holdings. And so the thing is that it's only just in the last couple of months, I understand, that those redemptions have stopped, and now you're beginning to see a little bit of inflow, but not much at all. So the global market, the underlying fundamentals in the global market are still in place, and the Western investor has no interest in whatsoever, especially on the equity side. Even though gold stocks, and we wrote a big essay about this about a year ago, gold stocks you could make the case in many valuation metrics, gold stocks are as cheap as they were back in the summer of 1999 when gold bottomed at $250 an ounce.
Indeed. And so, Leigh, just on that point, with respect to the GDX, if you kind of rewind back to 1999, active gold funds, active gold equity funds, were the way retail investors could play the trend, right? And I just wonder your thoughts on just how effective the GDX package is, so to speak, right? This is a market cap weighted index that may not be reflecting some of the best companies, right? Like maybe just your thoughts on whether we see a change in the dynamic. Obviously, we're still yet to see new money inflow into gold equities, but whether there's a chance that they move more into, obviously, you're an active manager, but are we verging an active renaissance, or will we see the GDX pick up first and then money come back in everywhere else?
Well, you bring up a really good point, and it's offset by some other points. You're right. Investing in the GDX is a very inefficient way, because obviously you're buying a portfolio of gold stocks, both good and bad ones, and that's not what you really want to do. You want to buy the really, really good ones. Now, offsetting that is that somebody who's been an aggressive investor in the gold equity space over the last 35 years, it's fiendishly difficult. And I like I said, I've had some spectacular successes, and I've had some spectacular failures, and it's hard in managing a gold stock portfolio to protect yourself against some of those failures. Some of them are predictable, some of them are completely out of the blue. And the thing is that I recommend for just a regular retail investor that either you buy a good gold mutual fund, and there's some really, really good managers out there, and you can either do that, or you buy the GDX and buy a little bit of market inefficiency, and then you don't have to worry about individual stock selection, which is the investing in gold stocks is a lot of fun, and it's fascinating, it's interesting, but for the average person, the challenges probably aren't worth the reward. So I recommend just for the average person, okay, buy the GDX. It's not, there are inefficiencies associated with it, but for you, it's probably the best thing. And it's interesting. Here's a fun fact. if you had bought the Amex Gold Bug Index, the Huey Index, back in the summer of 1999, do you have any idea where its cheapness today is, or the cheapness back then is rivaled by the cheapness today? That index between 1999 and 2010 went up 60-fold. So the thing is that even though there's inefficiencies, you could probably do better in your own. If you are a true insider in the gold stock space, you probably do better than that. But hey, 60-fold, I'll take that. So
yeah, it's pretty good. For
so it's offset. Yes, there are inefficiencies investing in the GDX because you're buying bad companies and good companies. However, for the average person who doesn't have the ability to really look into the gold space intently like I do, but even I make huge mistakes. So I think the GDX is appropriate for some people.
And you still think it's a good indicator to show that incremental buyers are not back in the market yet?
Oh, I think that is, if you're a gold stock investor, that is the most important data point that's in the gold market today. There is still negative interest there's money coming out of this space. And you could actually see it. Like, for example, if a Canadian company does a big bought deal, what happens to the rest of the gold stocks? They all go down. Why do they all go down? Because the people that buy the bought deal aren't getting inflows. They have to satisfy their own outflows. So they've got to sell everything to buy the bought deal. So the market's got the feel that capital is being withdrawn from it, which of course is an incredibly, if you're a contrarian, that's an incredibly bullish data point. And like I said, if the number of shares outstanding in the GDX were exploding, then I would say, hey, we've got some problems here in the gold market. But we're in the exact opposite position.
Leigh, just with respect to Trump and maybe your thoughts on all the things that Trump administration is doing. Is this just supercharging the inevitable? Or maybe your thoughts on strong dollar? Like, how should an investor take what the U.S. administration is doing, and as it relates to gold and positive, negative?
Is the cat out of the bag on like the risk to holding dollars now if you're a foreign country, that it's not going to go back to the way it was?
Yeah, I think what's going on in the markets today is that it's putting in place the backdrop of the perfect storm for the gold bull market, and I think that one of the things you mentioned, Trump and all the turmoil and confusion that is associated with the Trump presidency is one backdrop, but the other data point, which is to me, just like, for example, I look at gold, I say, what's the most important, one of the most important indicators of the gold market is the number of shares that GDX keeps going down and down and down. On the backdrop of the gold situation, what's the other massive data point that's emerged that very few people are talking about, although the chatter is increasing, and that is the fact that the U.S. government is broke. And the question is that Ken Rogoff had that great op-ed piece in the Financial Times on Saturday. He pointed out, I always thought one of the great must-read books is Reinhardt and Rogoff's. This time it's different. 6 centuries of financial folly, the history of sovereign default. And in that book they describe all the sovereign defaults that have taken place over the last 600 years, and they characterize all the underlying facts that caused those defaults to take place. And the United States is basically ticking off almost all those boxes. And okay, so we have a reserve currency, and we can rely on that for a lot. But the fact is, the U.S. government is going broke. And the question is that it's that very famous saying from Mark Twain. Ernest Hemingway, that how did you go broke, sir? And he said, the answer to that is slowly at first and then fast. And the thing is it's been slowly at first. And now we have the potential for it to really accelerate. And as it could happen, it'll be a black swan event. It'll be some sort of geopolitical event that'll coincide with a 20-year or 30-year bond auction. They can't get it done. And then what happens? You have a failed auction. And that's going to be a crisis. And then all of a sudden, you combine that with the fact that the Treasury Secretary, the Treasury in the United States now, because of the debt ceiling limits, hasn't issued any new government debt now for the last 3.5 months. And so the thing is they're drawing down their balances at the Federal Reserve. Mm-hmm. And the thing is that can only go on so long. And so when the debt ceiling is lifted, which it will be, they're going to have to issue a massive new amount of government, not only to fund rollovers, but to replenish their checking account. And so we're going to have a surge in Treasury issuances. Maybe that will be the black swan that people aren't properly, incorporating into their analysis. But the thing is that I'm convinced that when this financial crisis that will be precipitated by the realization that the U.S. is going broke, is that there's two outcomes. One is like the 1930s, a deflationary implosion, and the other one is a massive surge in inflation. And I believe that it's going to be a surge in inflation, and that is going to be the huge pusher of the gold market going forward. Maybe not in the next year, but soon. So I think the fact that the deteriorating U.S. fiscal situation combined with all the Trump dislocations and confusion is the perfect backdrop for the global market.
And maybe just your thoughts on localized supply chains, because if we are going to a deglobalized world, surely that adds to the inflationary tailwind. If China was a deflationary component of the last 20 years.
Oh, when you think about it, obviously since the early part of the 1980s, we have been in a disinflationary environment. And one of the big inputs to that disinflationary environment has been the globalization of the global economy. The idea that we've been able to access low labor costs, low cost supply chains everywhere. And it's amazing when you think about that iPhone that's in your hand costs $1,000. That has 12 million times the computing capability of an IBM 360 computer in 1965 or whatever, and that only costs $1,000. And so that type of deflation is been a result of globalization, and we're undoing that. So of course that's going to produce more friction and more upward cost pressure. So
yeah.
Now, I was wondering maybe I can move on to silver a little bit, because you talked a lot about gold. I'd love to get your take on silver as it relates to gold. We've seen the silver to gold ratio. People watch that closely. That's come in, meaning silver has been outperforming gold lately. Just from a high level, I'm wondering, how much do you think industrial demand, specifically solar, has it really changed historical demand patterns for silver? Like, should we see that silver to gold ratio lower than it historically has? How do you think about silver in a portfolio with gold as well?
Well, it's so funny, and I think we've talked about this in our previous discussions, is that, I'm a big believer, and if you study every gold bull market, and this is, this gold bull market is playing out just as I thought it would be, is that silver ironically lags a good portion of the gold bull market. And that's why silver bulls get so frustrated. And other than this last move, that's, basically silver has radically underperformed gold over the last 3.5 years. And the thing is now is playing a little bit of a catch-up rally. But I believe that silver will continue to lag as this gold bull market unfolds. Not that it's not going to be a good investment. It's going to go up, but it's not going to do as well. And if I'm right that we play out using that lagging framework going back 1971 to 1973, 1978 to 1980, 2008 to 2011, and finally from 2017 to 2020, that silver will lag, and then it plays a massive catch-up rally.
Right.
And then you have to be careful that just like this happened in the summer of 2000. Silver staged like almost 125% rally in 2 months, 3 months to catch up with gold in the summer of 2020, and that was the end. And what did gold do the next 3.5 years? Went down to sideways. And the thing is that, so I think this silver is doing what it's always done. It's going to lag, and which doesn't mean it's going to be a bad investment, but it will play a massive catch-up rally in the end, to the point where that if I'm a firm believer that when this gold bull market is over and silver does play that massive catch-up rally, that you're going to get the gold to silver ratio down like you did back in 1980, where I believe it got below 20, and it almost got a couple of days it got down to 15, 14, which goes back to Alexander Hamilton's ratio, that he put in, in 1790 or whatever. Yeah. So the thing is that if one wants to buy silver here and then hold it for that catch-up rally, it's gonna outperform gold. But in the interim, there's going to be a lot of frustration involved, and I think we're seeing that frustration. I know a lot of people always ask me, "What's up with silver? What's up with silver? What's wrong with silver?" And I say it's doing what it's always done. So it's catching up right now, but I suspect it will start to lag again after this catch up.
Okay, Leigh, I've got a good follow-up question for you. If you had to pick, we're on an island and we have to own stuff. Would you own gold bullion versus gold equities or silver bullion? If and that there's this blow-off phase coming on silver. My question is, are gold equities, and maybe you can side comment on silver equities, but I'm kind of, surely gold equities have kind of that torque that you possibly get over owning silver, but I would love to get your thoughts.
Yeah. Now I'm going to throw a real curveball at you guys, because I'm not going to pick any of those assets. I'm going to say you want to own platinum.
Oh, okay.
What's the dynamic there? Educate our audience.
Well, for our audience, if you're curious about what's going on in both the platinum and palladium market, please go to our website, gorozen.com, pull down our last letter, and our introductory essay is all about the coming bull market, both in platinum and palladium. And I think it's a really good essay for those that really want to basically learn what are the underlying fundamentals in both the platinum and palladium markets today. And I think I haven't been a player in these markets for almost 30 years. We had huge investments in the platinum group metals back in the late 1990s, and they were spectacular investments. And we had done all our research back then, and we've done all our research now. And I think the setup today in platinum group metals is as exciting as it was back in 1999 and 2000. Now, the reason is that the reason why platinum is particularly interesting. I grew up in a world from 1980 all the way to 2010 or whatever, that platinum always traded at a premium, or most of it, 90% of the time, traded at a premium to the gold price. And why was that? Well, platinum had a massive investment component to it. And the thing is that people bought platinum and stored platinum just like they would buy physical gold for the very same reasons. And that investment component for platinum is completely vastly disappeared, and which has caused a massive dislocation to the gold price. In fact, when gold was $3,300 the other day, platinum, I believe, got as low as like $950. So, I mean, that's incredible. Well, what happened if I told you that maybe in this cycle the platinum will begin to surpass the gold price going forward? And wow. I could make, I mean, that is just talking from investment standpoint, but I can make it a very, very good case for supply and demand characteristics. And I recommend your followers, you guys, that to go onto our website and read that essay. It's a really, really good essay that is describing what's going to happen to both platinum and palladium in the next, potentially 5 years. And I should point out too,
Leigh always keeps us on our toes.
Fantastic. Well, for those listening, we'll try to put the link in after the live on the site, but also we have a summation of our notes from the conference, so we'll include that as well, the link to the note. So thank you, Leigh, for that. Now maybe just rounding out one question, a little away from hard money, but on on physical assets, specifically energy, right? Maybe your thoughts. There's so much reverberation, so much talk about parity around having solar plus a battery install, and the leaps and bounds. I know there was in China, cattle, CATL had an IPO, just, where installed battery capacity is going, specifically, for these installations, in utility grade solar. Maybe your thoughts on, do we reach that? Is there a point, a risk for an energy investor, be it coal, be it natural gas, that we get this disruptive force from this combo of solar, wind, or and battery, right? And also you can throw in, does that compete away nuclear as well? But just maybe your thoughts on how real this threat is.
Have we reached parity? Will we reach parity?
No, you'll never ever get close to parity because you're so far away, and people just don't understand that. And I'll give you some numbers. For example, we're a big believer in this whole energy return on energy invested versus energy return argument on all on all energy sources. So what you do is you calculate how much energy goes into that energy producing source and how much energy does it wind up producing. And of course, what's interesting so much about hydrocarbons is that they are unbelievably energy efficient. We were talking about before about energy density. The energy density is so great that you say a natural gas plant. You drill for the gas, you produce it, you transport it, you build a plant to turn it into electricity, and that 1 unit of energy produces 30 units of energy out the other side. And that's very, very efficient. Okay, let's compare that to a solar farm. You take 1 unit of energy, mine all the metals, everything that go into the building of that solar farm, make the polysilicate slabs, which of course is very, very energy intensive. And when it's all said and done, that 1 unit of energy, how many units of energy does it produce out the other side? 5. Right. In a super cutting edge wind farm with the biggest windmills and things like that out in the North Sea, maybe it depends because they don't these wind farms don't operate at their feasibility levels. It's anywhere between probably 12 to 15 in optimal. Again, half, and that's before buffering it with batteries. So remember, making batteries is unbelievably energy intensive. And so that reduces everything. So you're going in the wrong direction. Now, this is what's so exciting about nuclear, is that a nuclear power plant, you take 1 unit of energy, mine the uranium, you process it, you turn it into a gas, you enrich it, you turn it into fuel rods, you build a $12 billion, 1,000 megawatt plant to convert it into electricity. That 1 unit of energy is going to produce 100 units of energy out the other side. Unbelievably efficient. Yeah. Now, here's what's even more exciting, is that, and the only reason we don't generate all of our electricity from nuclear power is because of the irrational fear of how dangerous it is, which it's not.
Right.
But that's an irrational fear. However, we're on the verge of a new massive capital investment cycle in nuclear power, which is, I mean, it could be hyperbole on our part, but we believe it's actually going to have the most impactful impact on society ever, only rivaled by what happened in the Industrial Revolution starting after the post-Civil War, before the Civil War period in America. And the thing is, and I'm talking about the introduction of the small modular reactor, and specifically the molten salt, the molten sodium modular reactor. And there's huge advantages of using molten salt versus using water as a coolant. And the thing is that, now get this, not only is it inherently much safer because you're operating at atmospheric pressures versus 150 times atmospheric pressures with like a Westinghouse AP1000 plant, but what's interesting is because you need 90% less steel and 90% concrete to build these plants because they operate at atmospheric pressure. You take that 1 unit of energy, what does it produce? 180 units of energy out the other side.
Oh, wow.
And the fact that we're going to realize that this is very safe. And in the fact that they're so efficient, you're going to wind up having all sorts of strange things happen, which people haven't put in their models. Say, for example, an independent power producer says, look, I'd like to build put a small modular reactor in your neighborhood. And it was, oh my God, you can't do that. You can't do that. You can't have a nuclear, 8-hour neighborhood. But then what happens if they say, okay, everyone that lives within a 10-mile radius of this plant gets free energy, gets free electricity? Because the energy efficiency of these things is so high that they could actually give away a huge part of the electricity generated and still have enough power to make a great internal rate of return on their investment.
Leigh, you've solved NIMBY. Like, why don't they offer that? That's actually the most genius idea to solve NIMBY. Take the power.
Yeah, but the problem is that with a big, huge 1,000 megawatt plant, that's a big thing, and
sure.
It's to be too dislocative. But these things are small, and they're safe, and they're highly efficient. So you can come up with all sorts of creative solutions to basically get this electric generating power system base into the global economy. And it's no, the people, the tech industry people are really smart, obviously, and there's no irony that who are the two big backers of molten salt based SMRs? Bill Gates and TerraPower, and Sam Altman and Oklo. And the thing is that what these data centers will realize, this is the perfect solution for what we want to do.
100%.
And so it's going to, as opposed to utility, which is like, oh, who cares, rate base, kind of get through the regulators. These guys really want it, and they're going to get it. And it's what's interesting is that standing in the way of all this here, the states at least, is the Nuclear Regulatory Commission. But Trump is in the process of emasculating the Nuclear Regulatory Commission and basically giving a lot of the powers to the Department of Defense. And so the thing is that this revolution is going to happen. It's going to be monumental because we've probably talked about this before. What is the biggest input to global economic growth? It's the ability to generate surplus power. And so the thing is that we're talking about basically a grid in the States, which is basically hydrocarbon based, basically 1 to 30, and we're talking about switching over to a grid that's not 130, 1 to 180. And it's the input to growth is going to be incredible. So anyway, I think there's a lot of very, very exciting things. And remember, solar panels and windmills, you go in the wrong direction. We've been banging on this idea forever. And if anyone can ever get a copy of our grants presentation that we did on the October 22nd, 2022 conference, where we talked all about this and how it was going to wind up destroying the economies of Germany, etc., in Europe, because of the idea that you're displacing incredibly efficient energy production, like from nuclear plants with solar panels and wind farms, and it's going to be a massive drag on economic growth, which it's turned out exactly to be.
Yeah. Oh, Leigh, that's a phenomenal overview of the energy landscape. Leigh, always a pleasure. Thank you so much for being always there for hard money, commodity one-on-one, all the Grizzle favorites. Leigh, thank you so much.
Yeah, thanks for your insights.
Oh, okay, very good. Thank you. And like you guys, I love being on your program, and it's an honor for me to be here. So thank you very much.
Thank you, Leigh.
All right, thanks, Leigh.
Okay.
All right, everyone. We hope you enjoy that, man. Leigh always dropping some amazing knowledge, and I love that he's opinionated. He knows his stuff, and he's not afraid to call out what he likes, and he's been right more often than not. So that's why we love bringing him on. All right, stay tuned. We're going to take a quick break, and we'll be right back with our next guest, Hard Money. All right, welcome back to Hard Money. Hope you guys have been having a good time. We're going to keep the interviews rolling, keep the energy up here. Next, we have Jim Hesketh. He's CEO of Viva Gold, a unique explorer in America. So let's bring Jim up. Hey, Jim, welcome to Hard Money. How are you?
Hey, Jim, how are you?
Yeah, doing good. How are you guys doing?
Very good.
We're doing great. We're having a good time. We're excited to talk more gold with you. So I wanted to start off, you've been in the industry for a long time. You bring a lot of perspective. Could you talk to us about the funding environment for gold projects? Gold is at an all-time high. Is it easy for any project to find the money to move forward? Or is the market looking at projects that tick certain boxes? And if so, what are those boxes?
Yeah, I mean, the market is definitely improving. Just spent 2 days in New York, had 20 meetings in 2 days. A lot of high net worth, had a packed schedule, a lot of interest, people coming in. But, one thing's clear, you got to have a solid game plan. It can't be just the next drill hole. You got to show people where you're going and how you're going to provide value moving forward.
Right. Okay, that makes sense. Now, I see you've driven significant resource growth at your Tonopah Gold project. You're now at 600,000 ounces or so. I'm curious what the ultimate resource number is that you'd like to hit and what you think is achievable before you get to a construction decision.
Okay, we're not, at this point, we're driving forward on what we got.
Okay.
The real goal is, number one, you got an amazing gold cycle going on. And you can drill right through a gold cycle, or you can try to take advantage of the gold cycle. So we're going to push this project forward through feasibility study and permitting. We got a resource that's probably close to 90% measured and indicated now. We should have a new release coming out before very long. And that'll be a new PEA and resource update. And, the real goal from that is to move the project rapidly to permitting after feasibility. And then, we've got an amazing permitting environment in the U.S. right now. So it's not something we want to miss.
Right. So there's nothing really standing in your way, it sounds like, from a regulatory perspective, which there could have been in prior cycles.
There's less of a regulatory bureaucratic roadblock. You still got to meet the same standards, but there's a drive to cut out bureaucracy, which is really the key thing. And the current administration is offering accelerated permitting. So really, that's a bandwagon you want to jump on. That doesn't come around every day. So our goal is to jump on, take advantage, and move forward, building value and de-risking the project, just getting it moving. So, gold in the ground is nice. Gold in your hand is much better.
Exactly. 100%. Well said. Well said. Now, I looked at, you have a good slide in your deck on the economics of Tonopah. They're really strong even when gold was much lower. So obviously they're looking really, really attractive now. I'm just curious, kind of overall high level, what do high prices do for you on a practical basis? Does it allow you to up the resource numbers? Does it give you just a buffer on economics? If inflation picks up, walk us through what current gold prices may mean for Viva.
Okay, you've got current gold price environment, and then you've got what you can use for feasibility studies and et cetera.
Okay.
Right now, the 3-year trailing average price of gold is about $2,200. The current market is a 1.5 multiple over the top of that. Our prior study was done at $1,400 gold. It showed tremendous leverage to gold price. In today's market, what we've got is your planning prices are 1/3 below current market. So your sensitivity to the upside, actual market, between that planning price and actual market is huge. Let's say you recover, and your project recovers 500,000 ounces recovered gold. Well, an $1,100 spread between a planning price and a market price, that's over $500 million.
Wow. Yeah.
Talk about capital payback and profit. This is an environment where you can go for extraordinary profits in production.
Mm-hmm. So I'm curious, if you do an updated economic study, what's the most likely gold price? Say gold prices stay where they are now. What's kind of the price that you think you'd probably use as the base case if you had to do that?
Well, like I said, the required gold price through the regulatory environment is your 3-year trailing.
Okay.
2,200. But your sensitivities are going to be at 3,300, 3,000, 3,300. So your sensitivities are going to be massive. The savvy investor needs to look beyond, the base case as to what the sensitivities really look like. The current spread between, planning prices and market is the widest in my career. And that's over 40 years. We've got the biggest spread I've seen in my career. And it's amazing.
But I mean, the interesting thing to me is, even at the 2,200, like the economics in this project look very, very good for moving forward. So it sounds like you don't need prices to even stay where they are like that. You have a really nice buffer where it could be way better than you think, but it's still going to be very attractive if you just move this through the permitting process.
That's correct. We've got to get through the feasibility and permitting process. You use the feasibility to initiate the permits. So that's really where we're going with Viva. We're not going to continue to drill for expanded resource. We're going to move forward on the engineering. We're going to try to drive through an open window that exists, and that open window is really a once-in-a-lifetime concept.
Mm-hmm. Right. So moving on to key milestones. If people are following along and they want to know, like, this is the one I've been waiting for. This is something that it may take longer to play out. Could you just walk us through your key milestones over the next little while? What should we be looking out for in the near term, and what would you need to accomplish with your studies to be ready to raise funding to get to that stage?
Okay, over the next couple, we hope over the next few weeks we'll be publishing an updated resource in PEA. That's a precursor for moving the project into feasibility style work. And the feasibility study will take probably about 9 months. And then we use that feasibility study to create a plan of operations where we initiate the environmental impact study. That takes us through the permitting process over the following year. We've completed the bulk of required baseline environmental study already. So what we've done is we've set this project up for a fast-track permitting effort. But then that allows us to move towards a production decision, cash flow, and we're in a district where there's lots of opportunity for add-on projects. So it's how do you build the next mid-tier gold producer? And that's really where we're at as a game plan.
Interesting. So I think you touched on this, the permitting. Could you maybe just round out, like, what are the permits you would need going forward, and what's the typical timeline on those to go through the process so that people really know, like, what are the milestones from today to first gold pour?
Okay, on permitting, we started 3 years ago with meetings with the BLM on our baseline study requirements. We've had write-off or sign-off on quite a number of our studies already. So we're very far into the process. But really, to create the final environmental impact study, you have to complete a feasibility study that gives you your what the project's going to be, the area of disturbance, and that's what you're going to the regulators to say, approve this disturbance on public ground. And that's a process we hope to move into next year. And it's about a 1-year timeline under the EIS process. There are statutory timelines for completion once you start it.
Okay.
But you can't start it until your baseline study work is complete, because that's the science that goes into the permit. And so that's why we accelerated that process and started that work about 3 years ago. So like I said, this is not a starting of permitting. This is the end of permitting we're talking about.
Right. So is that something people who aren't in the industry may not know, that you can move through the process before you are officially submit all your documents and start that ball rolling, which speeds things up a bit?
That's correct. And that's what you really want to do. And we've been in that process, like I said, for the last 3 years.
Interesting. So the feasibility study, you were saying you're pushing to have that done middle of next year is the goal, or just refresh my memory?
I'm thinking early next year, because I'd like to be able to get started on that later this summer. So, you can move quite rapidly into that.
Great.
Okay, that's amazing. So it sounds like the long-term plan is you get into production as fast as possible to harvest the cash flow from record gold prices, and then you see a lot of other interesting land packages around where you are that you could reinvest in.
Yeah, I mean, there's permitted development opportunities that are already permitted in our district. So there are acquisitional opportunities in front of us. But
in advanced stages.
You got to start somewhere. You got to get the cash flow moving, and you don't want to continue to dilute your shareholders. You want to move forward.
Right.
Jim, one thing you mentioned is just, this has been a record differential between, where the market price is for gold and, what companies are baking in. Just maybe your thoughts on, the opportunity ahead for Viva and for gold investors. Just, are we on a precipice of a floodgate of investment? Just because obviously there's this massive gulf, and projects like yours obviously are very economic at much lower gold prices.
Yeah,
you just were talking to a bunch of investors, so maybe send them a check.
Yeah, I mean, this is a unique environment where you can actually turn a lot of this exploration work and all the rest of it into cash flow, into physical gold. And that's where you really build the value for your shareholders. And so, it's not a time to sit there and waste. You got to move quickly. You got to do the hard work. But it's driving that value for the shareholders through trying to get to a gold productive state.
Yeah.
And, the drive there, you have the opportunity to be able to accumulate cash. And that opens up a huge amount of other opportunities.
Right.
Yeah.
The bottom line is, how do you build a business?
Yeah, that's right. That's well, Jim, thank you so much for a great overview. It's an exciting project, and look forward to staying up to date through the rest of the year. But thank you, Jim. As always, Grizzle Hard Money.
Yeah, so it's Jim Hesketh, CEO of Viva Gold. Thanks, Jim.
Thank you very much, guys. Pleasure being here, and have a great day.
Thanks, Jim.
All right, guys, hard money train keeps on rolling. Don't go anywhere. We'll be right back with our next guest. All right, everybody, welcome back to Hard Money. Our next guest is Ross McElroy. He's CEO of Apollo Silver. We're going to get him in here. Ross, it's a pleasure to have you. Welcome to Hard Money. How are you?
Fantastic to be with you guys here today. No, I'm doing well, thank you.
Thank you for joining us.
Now, Ross, I wanted to kick things off high level here. I'd love to grab your opinion on the state of the silver market based on your experience. You've been in the silver market for a long time. Ease of raising money, investor interest, confidence in stable or rising prices. Like, how does this all look versus prior cycles in your view?
Yeah, well, obviously silver's on a definite upward trajectory. Currently this year alone, it's probably up some 25%. Since the beginning of the year. It's following in the heels, obviously, of what gold has done. Gold has been such a stellar performer in 2024 and 25. Silver is playing a bit of catch up right now, I think, and we all know the silver market, tends to rally really quite. Well, let's just call it volatile. It's a smaller market, and so when things move, it moves a lot quicker. I think I think we're in really for a prolonged bull market in precious metals in general, and and as I say, silver is playing a little bit of catch up with gold and with respect to that. But I can't help but feel extremely optimistic about the state of the the silver market right now, and I think it's a great time for companies like us to be active, and really a great time for investors to have a look at your portfolio and add silver to that component.
Great. Fantastic. Now, Apollo, you guys own two different properties, and they're in different parts of the world, and there's some similarities and differences. Could you just take us through those two properties and talk about them? One's in California, one's in Mexico. What are the opportunities and challenges you have to work with on each from maybe a regulatory and operational perspective?
Sure. Yeah. I mean, they're both silver properties, silver dominant properties. But just to start with California, Calico, that's a really good project that we have. Globally, we've outlined over 160 million ounces of silver. The majority of that resource is in the highest resource classification of measured and indicated. So you've got 90 million ounces of measured, you've got 20 million ounces of indicated, an additional 50 plus million ounces of silver that is in inferred. There's also a small gold component to it. We have a little gold zone that's distinct and separate from the silver deposits. That's something that we feel has the potential to grow as well. So it's very good. It's located in the San Bernardino County, and I guess one of the comments I have in California, if you are trying to develop a project in California, San Bernardino would be your absolute number one jurisdiction to be doing so. So they're no strangers to operating mines in San Bernardino, and this is where we find our project. It's pretty near infrastructure. It's located almost halfway between Los Angeles and Las Vegas. As I say, it's an advanced resource story with 160 million ounces globally. But it's one that can really move itself down the economic food chain, ultimately to become a producing asset. So it's really the next level for us is we have a barite component to the deposit itself. Barite's classified as a critical metal in the critical mineral in the U.S. Classification. I think that garners well for permitting reasons, and so I don't know. I think it's a really good advanced project in probably the best place in California to be. The other project, Cinco de Mayo, is an option that we got from Mag Silver. It's in Mexico. It's in northern Mexico and in the northern state of Chihuahua. It's a CRD deposit, a carbonate replacement deposit. It follows along a very long trend of large, high-grade type deposits like this that are dominantly silver, zinc type deposits. That's what we have in Cinco de Mayo. It's an option to earn in 100% of the project. What we have to do is meet, be welcomed back by the communities in the area. So we're looking to achieve our social license at Cinco de Mayo, first of all, Cinco de Mayo, and then we'll drill 20,000 meters, and at that point issue 19.9% of Apollo's equity to Mag Silver, so they'll become our largest shareholder, and that will complete the option agreement. So we have another 4.5 years in which to complete that, and then we would have a tremendous asset, high grade. There's already historic resource on it. There's lots of room for growth on Cinco de Mayo, and I think that's really the blue sky potential in the company.
That's excellent. I want to drill in a little bit on both of those. Maybe I'll start with Calico. So you're at 161 million ounces of silver. I'm curious what your resource goals are for this project to enable, say, a final investment decision down the road. What's kind of a minimum resource number for you that you would be happy with that you think is achievable?
Well, I think at 160 million ounces, you've already got one of the largest primary silver deposits in the U.S. I think that from a size perspective, it's probably already there. Okay. The grade of the deposit overall on the measured and indicated material is about 100 grams per ton. So what's that work out to? Just a little over 2.5 ounces per ton. So the grade is pretty good. The size, I think, is exceptional. So for us, I think economics are going to be, what's the sort of daily throughput of how many tons per day, that kind of thing. How do we develop it? Permitting, of course, is going to be, something that we'll be working our way through over the next several years. And I think with the price of silver, once we started getting north of $30 silver, 31, 32, I think the economics start looking potentially attractive. Now, we haven't done any advanced economic studies. We've only done a resource estimate, and so all the view at this point is what is the size, what's the grade, what's the quality of the deposit. But I think it all lends itself to be certainly a very mineable deposit. It's shallow, it's near surface. That always means a lot, and so over the next year or two we'll be moving Calico through the paces to through a PEA, first of all, a preliminary economic assessment. We'll be moving to a pre-feasibility study after that, then feasibility study, and then you can make a mining decision to go forward. So really that's the next 2 years or so would be in more advanced economic studies to see that it can hold up against that. But I think with silver prices the way they're going, it's already in the territory that makes it quite attractive. And then maybe the one other part I'll add to Calico is we recently announced an expansion of the land package there by almost 3 times, so 2.5 to 3 times the size of the existing land package. So importantly, that additional land is right on the same trend, the prolific Calico fault trend, of which hosts it's the reason that the silver deposits and the gold deposit are there in the first place. And we're basically capturing the ground along strike of that. So we think there's plenty of exploration upside on the project too. So we'll be putting efforts into both on the economic front and on the exploration side to find additional resources.
That's great. So I'm hearing resource is not an impediment to you moving forward. It's already kind of where you need it to be.
Yeah, I think that's true. I think it's really just a matter of understanding the metallurgy a little bit more, some of the geotechnical issues. So the things that you really start to consider once you get into the economic phase of the equation. But from a resource size, I think it's already there.
Great. That's good to hear. Now, I wanted to touch quickly on barite. You have a good slide in your deck I'm going to bring up, but I just wanted to, maybe you could expand for people who don't know barite and how it all plays in. Now, number one, is there a supply shortage in North America? And secondarily, how much of a return enhancer would this be for Calico if you're producing it along with silver?
Yeah, maybe just the second part of your question first. There's a historic barite calculated, by previous operators on the project. What we're doing right now is turning this into a current resource. So we're doing work in order to update the Calico resource estimate and include barite. So it'll be part of the economic assessment, going forward. I think with the amount of barite that we see on a historic basis in there, that'll probably add somewhere in the equivalent of another, say, 10 to 20 million ounces of silver equivalent. But I think more importantly than anything is the fact that that barite is probably a strategic mineral more than it is an economic enhancer to the project. It's on the critical mineral list of the U.S. And so I think that'll help and go a long way in our permitting side of the equation to be able to bring barite into the fold. I don't know that there's necessarily a shortage of barite worldwide, but the U.S. produces almost none of it. They import everything from China primarily, Eastern markets, and you can certainly see the emphasis these days on the need for the U.S. to be able to grow its own, in everything, become self-dependent on its own resources. And so I think strategically, barite's important. It's used in drilling, drill mud. So really, that's its downstream use. And with the new quote the current president, with the drill baby drill type motto out there, I think barite is an important component of that motto. So we think it's going to play well for our market, and it's something we're going to focus on. We'll have a resource update probably late summer, early fall on Calico with the the barite component added.
Oh, good, great. Yeah, that was a great angle to talk about the permitting. That makes a lot of sense there. Now, I just wanted to move on to Cinco de Mayo because this is a really interesting asset. Could you just talk to us about the opportunity you saw before signing the deal, given the operational risks that were out in the open at the time? What are you hoping you can do there?
Yeah, I mean, the short story at Cinco de Mayo was an absolutely brilliant discovery by Mag Silver. They made the discoveries of mineralization from 2008 basically to 2012. They've outlined a very respectable high grade manto, the upper manto zone. Basically, it's a silver rich and zinc rich deposit. I mean, there's a historic number there of almost 1.8 billion pounds of zinc at over 6%, 6.5% zinc. The silver equivalent, there's about 50 million ounces of silver in that historic resource. Lots of room for growth. Mag ran into trouble back in 2012. For whatever reason, they got offside with the community. The community voted for a 100-year mining ban, essentially, on there, and basically didn't allow Mag to do any further work on the project. That's 12, 13 years ago. The opportunity we saw is that this was an incredible project, probably worth at least on Mag's book, in their market capitalization, probably worth $400 or $500 million of market cap on this asset alone. It is absolutely, there's a lot of room for growth and a lot of reason to be excited about it. The last hole that Mag drilled in 2012 hit a brand new zone with about several zones. The most important being about 62 meters of solid massive sulfide mineralization with equivalent kind of grades that we saw in the upper zone, the upper manto zone, but in a brand new one. So it's got plenty of room for growth there. There's already a gold moly deposit also on the project, located another 3 miles to the east of the upper manto zone. That's one it's probably a lower priority for us at the moment right now, but we want to get back on the ground and start working at at Cinco. But really, what that requires is approval from the community, showing that we're a new group, new management. We have a fresh face. We're there to support the community, help build their infrastructure. Help them to realize what the economic benefits of having such an important project is in that area. This is a project that right now, as it's defined by drilling, and as I say, it's still wide open in many directions, but this is already one that it promises to be very, very economically viable, a significant project along this Mexican belt of other such deposits. So, we think there's great upside right now in the company market cap. We're probably not getting any appreciation for the Cinco project, and that's because we don't have the social license yet to be operating. But once we do, I think this is going to be a huge growth story for us.
Ross, thank you very much for a great overview, and look forward to following the Apollo story. Thank you for joining Hard Money.
Thanks, Ross.
It's been a pleasure, you guys. So let's talk further, but hopefully the conference is fantastic for you.
Thank you very much,
Thanks so
Ross.
Much. Appreciate it. All right, everybody. Hard Money. Hope you've been enjoying. Remember, live Q&A. If you have a question for any of your guests, anything you're not clear on, or you want to, dig a little deeper, put it in the comments, and we might ask it. So we're gonna take a quick break, and we'll be right back with our next guest. So don't even.
All right, welcome back to Hard Money. It's a pleasure to have our geology segment with Steve Beresford, the king of polymetallics from Power Metallic. Steve, how are you?
Welcome to the program.
I was going to say Prince of Polymetallics. It sounded a little better, but it didn't give the gravitas. So I had to go with King. I'm sorry. It was the Prince of Polymetallic. It sounds like you're still vying for King, but
yeah, you are the king. Let's be real
here. Thanks for the plug.
Steve, pleasure to have you on. How are you?
Good, thank you. Thanks for the invite.
Well, Steve, you know what? First of all, I wanted a big thank you. You did a Polymetallic 101 with me, and it was fantastic. It was a real good primer. If anyone's listening right now wants to watch it, it's on the Grizzle channel. That was great. And the idea is, so from that, we really got a good idea of polymetallic systems. And Steve, I thought it'd be a great opportunity to bring you on for Hard Money to talk in our geology segment about polymetallic systems, and just give us the intro on polymetallics. They're rare, but they're abundant in resource and vavalue. Maybe that backdrop, but also we'll dig deeper into the precious metals component, because it is kind of like it's your cornucopia of elements, right? It's not just one element. So yeah, Steve, please take it away.
So polymetallic is a subtype of nickel sulfide system, but a lot of nickel sulfide systems vary in their quality, and that's really important. In fact, that's one of the main mistakes the world's been making, is chasing what I would call the wrong types of nickel sulfide systems. So what's the right type of nickel sulfide system? Well, it's not just a geological feature, it's an economics thing. So straight economics, so about as pragmatic as you can get. So there are always lumpers and splitters, but the analogy I would make is if you go chasing porphyries and you end up chasing the wrong kind of porphyry, you'll end up with the wrong kind of metals. So nickel sulfide systems vary in nickel, copper, and PGs. That's the way we tend to summarize them. But you can get some very nice looking nickel sulfide systems. An example in Canada would be Voisey's Bay. But Voisey's Bay is not a polymetallic system. You could have the recent Tamarack intersection, which is stunning, beautiful intersection, but it's not what we're talking about. Okay, so we are having a conversation about a particular subtype. Why? Because it's economic, more superior in economics, and it's superior in economics because it's zoned. So it ranges from nickel to copper rich, what we call a cuprous zone. In other words, a copper zone. And that copper zone is basically massive copper minerals, chalcopyrite, cubonite, or bornite. And with all those copper comes the rest of the story. Highly enriched in the noble metals, platinum, palladium, and for the sake of this conference, also silver and gold. And the silver in particular is ubiquitous, the gold not necessarily, but you end up with what Terry Lynch calls the jewelry box, or what Rob Freeland calls the jewelry box, which is these incredible grades. So a lot of people go, oh, but it is still a nickel system. Well, if that's what you want to lump everything together, then we're also lumping together uneconomic or poorly economic with extremely economic deposits. So a little bit of nuance, but the nuance matters in economics. It also matters that you want your copper zone to be at the top, because if you want it in this modern day and age of copper systems, two things that are really important: capital intensity and capex payback. Capital intensity, basically, how big is it going to make it and how long is it going to take you to build it? Well, high-grade systems with high-grade noble metals and everything, small capital intensity, small payback periods, all the fruit comes first. Everything is at the top and everything is good. And then the rest of the nickel system, which will be zoned, is in the rest of the mine life. So it's basically optimum economics.
Fantastic.
That's great.
Fantastic. And, maybe just a bit of history about, the large polymetallic mines that, that have just been juggernauts, right? And just, how long, maybe comparing and contrast of, obviously Power Metallic has something very special at NISC, and, we'll get into that. But I think a good backdrop is just, how rare these are. I know Terry had a tweet recently that just really talked about, I want to say it was 21 of them, but it was a good little map showing everywhere they were. But would love to get your take on the history of these systems, how rare they are, and why you guys feel that you have something very, very tangible at NISC.
So the kind of processes that operate, the geological processes that operate, are called massive sulfide fractionation, and all deposits have this. But some deposits are capable of systematic zonation. What does that mean? It means it completely zones from a nickel goodies to a copper goodies. And that's the process that's rare, and that's why we get mines, that the mines are rare. So the last discovery was 18 years ago in Seyffart in Finland. That's the topical one that's owned by Anglo American. It's an amazing little discovery with copper at the top and nickel at the bottom. Now, Canada has a famous example, all the Sudbury deposits. And a lot of people balk at that because those geological experience know that the Sudbury's got a different origin, but each individual Sudbury deposit, and there are many of them, are zoned from nickel at the top to copper at the bottom. And in the Sudbury situation, that means all the economic copper goodies and PGs and the like are all at the bottom and deep. So a lot of Sudbury system, because it's a mature camp, a lot of the stuff is getting deep. In an ideal world, we would turn it around and we would have copper at the top and nickel at the bottom. Copper, not just because copper is a better element at the moment in terms of topical, but because copper comes with platinum group elements and it comes with the gold and silver. So it's the total copper equivalence. a lot of the time when the world uses copper equivalents, it's trying to hide something, but sometimes it's just telling you that there is a polymetallic nature that has to be captured somehow. And that's really important for the noble metals because they could be 33+% of the value of your ore body. You don't want to leave them out, especially if they're metallurgically sound. So those are already, so Sakatti is world-class, Sudbury is a super giant. And this is what always causes a bit of angst because the biggest example is in the Norilsk camp. Now, the important thing to realize is Norilsk itself contains a number of deposits. Norilsk itself is a relatively small nickel sulfide system. That's not what we're talking about. That's not polymetallic. The big supergiant Talnak is also not a polymetallic system. And then there's the real big granddaddy, which is called Oktyabrsky. And that's the world's biggest deposit of any type. That's a deposit that can output porphyry level copper per annum, plus world-class nickel, plus world-class palladium, plus world-class gold, all in one deposit. So that's why, I spend a lot of time on podcasts repeating myself about economics, not just about geology. If you think your deposit is capable of all of these things, then you're mistaken. That's a very special set of circumstances that gets everything. It's like what I call the periodic table deposit. So somebody on one of these calls the other day asked me, how come you're not mentioning Voisey's Bay, when Robert Friedland's one of your investors? One of the very first conversations we had with Robert, he said, why is Voisey's Bay not like this? Not that kind of system, Robert. This is different again. This is special. Now, everyone's like, oh, well, this is PR. You're drawing attention to yourself. Straight geology. This is not like Voisey's Bay.
That's
interesting.
Very helpful. Very helpful.
That's great.
And maybe you could give us Oktyabrsky, just maybe highlighting on that, just because of the characteristics there. Maybe you could talk about just why you guys feel like obviously you've had great drill holes. It's been an incredible story at Nisk, and now you have Line and Tiger. Maybe you could give us a little bit of the history and compare and contrast some of the characteristics that you're seeing that gets you guys very excited. And Terry is very excited. He just seems to be more pumped up every time I see him, but it's a good thing.
Well, things are going well. That's why it's not always as simple as this. And at the moment, life is pretty straightforward. So what would you expect? I mean, one way is to think about scale. So often nickel sulfide systems cluster at what we call a camp scale rather than a district. So what does that mean? It means a district might be on the order of 100 kilometers plus, and that's quite common for porphyries and VMS and gold systems that everybody's familiar with. Nickel systems very rarely cluster at that scale outside of komatiites, and we won't get into that. But they do cluster very, very tightly in what we could call the camp scale. So on the scale of tens of kilometers in and around. And there's an expectation you'll see many systems, but not all of those systems will be polymetallic. So this is the important thing. Everything's going to come with poor nickel sulfide systems, average ones, and then some super stuff. So the Norilsk camp is a good example. Remember, Norilsk is small. So the Norilsk camp is big. Sudbury itself contains small deposits and fully zoned systems. And we lump it all together. So when someone says, Sudbury's massive, it's like, yeah, that's because it's made of many, many small deposits or many small high-grade deposits. That's how this game works. So the next thing from Lion and Nisk is to take it and find multiple. So Lion is far from finished. Nisk still has potential under it, but Nisk at the moment, which is the first discovery, is a nickel sulfide system. And if we're going to turn it into a zone system, it's in our future. But Lion is copper at the top. Now, the key thing to recognizing this is there's virtually no nickel with it at all. So it's not like a copper-rich nickel system. It's a copper zone. It looks like a copper-rich VMS. It looks like here in WA, where I am right now, which is Big DeGrussa. It's hundreds of thousands of metal tons of copper and PGEs and no nickel. But it's going to zone into a nickel system. So we should judge it as a copper system. We should call it a copper system. That doesn't happen in all these sort of systems. So the reason why Terry's excited, why I'm as excited, is because we will keep doing this. We will just keep now loading up these systems. Now, are we going to find nickel systems? Yes. Are we going to find nickel at the bottom of line? These things are yes. Are we going to find another polymetallic? I hope so. But that's the fun part of this game. Is we're 1 year in. If you compare this to the Sudbury and Norilsk camp, they're hundreds of years in. If you compare this to a lot of other systems, so the average age in finding the rest of this cluster can be time consuming. But at the moment, we're well funded. And we're aiming. We're going fast, man. This is as fast as this sort of system goes. So the reason why Terry's smiling, the reason why I'm smiling, is because this is a wonderful start. But we're closer to the beginning than we are to the end.
Fantastic, Steve. And maybe just a question just on the recent results. They've been great. Just you can help us talk about where the telltale signs are right now with the geology, and what you're looking for, and maybe set us up for the next year ahead. And also, I will add that there was also a news release about you guys adding a land package, and just would love to get obviously insight on that as well.
Yeah, so adding the land package is obvious. We've talked about scale of clustering, so it's pretty obvious that we know what we're doing, and we will continue to deliver these. The recent results, a few people, some of them have been a bit skinnier than we used to. We're back to the nice thicknesses again. I've mentioned this 1,000 times, really, literally 1,000 times. This deposit is what we call geologically remobilized. So what does that mean? It means it's deformed. So it's very different to Norilsk camp, for example, or the Tamarack, which is in the news this week. So different geological controls. If you can't use the same criteria, the positive of the style that we've got is it thickens and thins. And the negative about the deposit style that we've got is it thickens and thins. So it's the positive and the negative. So what's causing it to thicken is structure. What causes it to thin is structure. And I'm afraid you've got to ride the porpoise here and just keep going. There's nothing we can do about this. We're just going to keep on going through these sort of moments. We know what to do, and Mother Nature will deliver the thickening and thinning. So zero concerns, other than I understand nobody likes things thinning. But I've mentioned this before. At some stage, it's going to thin as if it's even terminated, and it won't have terminated. That is the uncertainty of this game. So recent holes, wonderful. I guess systematically, what is important? The holes are getting richer in nickel. And that tells you something pretty important. I always said this was going to happen, that we're getting towards the nickel. That's what's going on. The system is zoning exactly as we said it would be. Now, what does that mean for the upside? Well, the message that I've taken you guys through with the polymetallic in the zone is a oversimplification by necessity to try and explain that we're going to go from a copper-rich goodies to a nickel-rich goodies, but there's going to be transition zones. And what's the geometry? As in, what is it going to look like sideways and stuff? It's like, we just don't know that sort of stuff. That's the sort of stuff that we use the drill rig to find out. So we know when it's going to be zoned. The guys are often say, how did you know that was going to happen? It's like, I can see when it's going to zone and when it's going to change. But the exact geometry and thicknesses and all that sort of stuff, that's what we drill holes for. That's how we find out what's going on. If we knew beforehand exactly how good it is, it wouldn't be called a new discovery. It would be already a mine. So that's the uncertainty of the game. But no concerns from my end, just thickening and thinning of a classically remobilized zone deposit.
Wow, that's helpful. Yeah. Steve, the company's lucky to have you because there is that uncertainty that comes from, these deposits and drilling in general. But because of your deep history, you can say, no, we got to keep going. There's something here.
Yeah, look, there's always different schools of thought, and I won't, I won't say that it doesn't bother me every time it thins. Of course, it bothers me. I'm tied to this deposit, and it always makes me nervous but I'm not in control of it. I've been telling people from the beginning that this was going to happen. And I've got a story, I've told it many times, of we brought in new geophysics and a very strong EM focus, which is just going so well. It's really, you can't imagine doing better than this in this game. At least I can't imagine doing better than this. And it's made such a difference to the company to bring in this focus. And the reason why that's important is every time you lose an ore body, when you're chasing something like a gold system, you have a tendency to reach out into the unknown and just keep drilling structure. And that's fine. That works really well in gold systems. But nickel and copper-rich sulfide systems have this huge advantage of being conductive, which means we can image where they are. So even when the ore body thins and appears to disappear on it, we can, using borehole EM, reach out into the unknown and image where it is and go, no, it's still there. It's just, and so that's massive for confidence, because if it looks like the ore body's going skinny on you, but there are still plates that have been developed in the EM that are sitting out right in front of you, the ore body hasn't finished. The ore body's just going through a dull period, and the next hole is going to generate the quality, and that's the confidence of all investors, not just people like myself who've got a bit of more experience. Everybody who's been working in the nickel sulfide game or high grade game is used to reading borehole EM. This is the weapon of choice in these systems, and it's been very successful. And we can't even, it's a step better than even perhaps most of the investors I don't realize. The biggest problem usually in these systems is that you have lots of false positives. So you have lots of things that are conductive that have got nothing to do with ore. That's actually the hard part of nickel sulfide. For all those camps that we mentioned, including Norilsk, their big problem is they've got lots of false positives. Every time you drill a hole, you don't really know what it's going to be. That's not our story. That is incredibly fortunate. But we can drill every single plate at the moment with 100% confidence. So maybe Western Musgraves here in WA is the only other example that can come close to that. You're in a system where most of your drilling is going into intersecting sulfide. So, wow.
Steve, a very exciting. You guys got a great year, and multi year ahead of you guys. Very excited, and Steve, thank you very much for taking the time, and it's always good to get a refresher on polymetallics 101. Steve, thank you very much for joining Hard Money.
Thanks, Steve.
Yes, thank you.
All right, everyone. We hope you learned a lot from that. Steve is one of the foremost world experts in polymetallic deposits, so it was great to have him on. Don't go anywhere. We're going to take a quick break, and then Hard Money rolls on.
All right, welcome back. The trade keeps going. Grizzle hard money, and we're welcome to have Will Robinson, VP Exploration of West Red Lake Gold, a good friend of ours. Let's bring him up.
Will, welcome to Hard Money, brother. How are you?
Hey guys, how's it doing? Yeah, thanks for having us back on.
Thank you very much. Will, I've always, every time we've been together, I've always learned a ton on the geology front, and it's always been good and enlightening. And last time we saw each other was PDAC. Hopefully we'll get you in the studio next time when we're doing the live as well. But great to have you here for Hard Money. Will, I'll start it off at a very high level with respect to you've got a long history in geology, looking for gold. Maybe, we're in this bull market. Maybe you could talk to us about globally gold geology, where you'd look prospectively, right? The areas that make sense, plus, where gold isn't necessarily where, the jurisdiction is great to pull that gold. So, you need an overlay there as well. But maybe you can kind of take us through, the most prospective regions, both from a jurisdiction perspective and then obviously a geology perspective.
Yeah, no, I think you opened that up quite well. Jurisdiction is very important. We're very fortuitous in that, I think, with West Red Lake. Not only just, within the Red Lake district, it's obviously a very pro-mining region, but just Ontario as a whole. I mean, with the new administration, and now it seems like it's all systems go for getting, projects permitted and moving things forward. We have the benefit of having a fully permitted mine at Madsen. But I mean, just looking ahead, just within our area of Red Lake, there's been so much activity recently with the earlier stage explorers, with developers, Kinross right next door, Evolution still doing their thing. We've got Kinnerland Minerals throwing out a bunch of tags for different groups, but it's really encouraging to see that activity. And for us, looking at other things in the district, that part of Canada for gold exploration is a great place to be. Ontario, it's got a rich mining history. We've seen that it's favorable and supportive, for more mining activity. And I think there's still a ton of discovery potential as well. And I think different groups that can move in and realize that potential and then set themselves up for success, especially right now, trying to get ahead of it, taking advantage of rising gold prices, taking advantage of some of the new permitting mandates that have been set, within the province of Ontario. Bill 5, for instance, I think we're in a really great spot. And speaking on geologic potential a little bit more, just for us, just on our Madsen property, huge upside. We had a pretty big program last year on surface. We drilled 12,000 meters. We had a number of what we consider to be fairly new discoveries based on new concepts that we implemented at our project. And so that just goes to show, they've been mining in that area for 100 years, but there's still opportunity to discover more. And not just discover more gold, but discover more high-grade gold. And so those are high-margin ounces, and that's what we're focused on at Madsen.
Great. I wanted to drill down on Madsen a little bit. So you've seen first gold pour at Madsen, which is a huge milestone. It couldn't come at a better time with gold at all-time highs. Just curious, from a geology perspective, what would you say were the most important accomplishments that enabled you to restart this high-grade gold mine?
Yeah, for sure. Number one for us in the geologic team, it was really establishing that runway of high confidence ounces. So it was all about the infill definition drilling from underground at Madsen. That started in October of 2023. And then we continued to hit it hard in 2024, added a second drill in April of that year. We're able to define roughly 100,000 ounces of high confidence inventory through 2024. So far in 2025, we're at that same pace. And so having that, that base of high confidence ounces to then build our mine plans on is just huge. That's the number one step that we have to do, and we have to do it right. And the team's been doing it efficiently as well. And so the rate that we've been adding those ounces or drilling off those ounces from underground with the two drills is more than enough to sustain mining as we move ahead. So we've already established a nice base, a nice foundation. And then looking ahead, we have very high confidence that we're able to keep up and stay ahead of mining, which is really important in an underground high-grade gold system. And then the validation of that we have is obviously the recent success with the bulk sample. I mean, we processed 15,000 tons. We, from 3 different areas within the deposit, from Austin, South Austin, and even McVeigh. And we had, within 5% reconciliation on those results. And so what that really demonstrates is that our workflow works. And we have that recipe for success. And so I think that was a huge, huge milestone for the team. And we can't take all the credit. The mining crew has to perform as well, and the mill has to perform as well. But it's really the geology that I think was one of the big question marks for a lot of folks on this story. And I think we demonstrated that it works.
Yeah, there's no better real world validation than what comes out when you pour it, right? And that's pretty
Absolutely.
tight band there. Okay, now I know you speak to investors quite a bit as well as running the mine. From your recent conversations, I'm just curious, I'd love to get a sentiment check from you. Are things euphoric with gold prices at all-time highs, or is it cautiously optimistic? What are you kind of hearing? What's the feel?
I think it probably falls somewhere in between. There's obvious excitement around gold price. It's just ripping. All-time high seems to be like a weekly occurrence with the metal price right now. It's getting a little hot, a little frothy. You can check the relative strength index on that just from one of the, statistical metrics, and it's getting a little bit hot. But at the same time, all the tailwinds that are in place don't really indicate that it's going to slow down anytime soon. And I think, people that may have not really been gold bugs in the past are starting to take notice of that and appreciate, the value that gold can have as a store of wealth, as a hard asset, as opposed to a fiat currency, which we can see inflation running rampant, worldwide and things like that. So a little bit more security in the portfolio for retirement, I think, is becoming attractive for a lot of folks. So we're starting to see a little bit of a circulation coming into our sector. And that's obviously not only good for the commodity, good for investors, but it's also good for the explorers. It's good for the developers such as ourselves and the miners. It's really nice to see a turning of the tides. So I think it's generally optimistic.
Great, that's helpful. Now, I'm curious what your drilling strategy is going forward now that you're in production. You can feel free to cover strategy for future exploration as well as I know definition drilling is really important to the project.
Yeah, for sure. For 2025, it's going to continue to be definition drilling focused. We are in a ramp up phase right now. The mill is turning. We're processing material at the mill. And so we got to make sure that we keep feeding the mine plan with that high confidence inventory. But with that said, even with the definition drilling, we're having a lot of success and we're uncovering areas within the existing deposit that are exceptionally high grade, that aren't necessarily represented accurately within the existing MRE. Recent results that we put out in 2025 from South Austin, include some really, really nice intercepts: 114 grams over 10 meters, 61 grams over 12 meters, 52 grams over 4.5 meters. So I encourage folks to go back to our news release section on the website or even on our most recent corporate deck, and we've highlighted some of those areas. So we do have exploration upside on the fringe of the existing Madsen resource and also near mine. But looking ahead a little bit with the exploration, that figure that you just showed from underground sort of lays a roadmap for where we'd like to be. And so that's getting development out a little bit ahead of mining so that we can start drilling off some of these new areas from the existing MRE that we also have very high confidence in. But one of the ones I'd like to highlight that's near mine and we see as sort of a near-term potential deposit that we could integrate into the production profile. Late 2024, we put out a news release on Fork, which is part of the existing resource at Madsen, but was always sort of envisioned or modeled as a lower grade, kind of 70 or 80 million ounce resource, but within the 4 to 5 gram range. So not something that was hugely attractive, as it stood, but we reinterpreted that and actually recognize that there's a very high grade, shallow, low plunging ore chute within Fork that's only 250 meters away from our existing underground development. And so we could get to that area in a fairly short amount of time. We could drill it very effectively from surface. So that's a near mine expansion opportunity that we'd like to, get after sooner than later. And we can, again, drill it pretty quickly with about 3,000 meters from surface in short holes. And so Fork is something that we're excited about. I mentioned earlier, we drilled about 12,000 meters regionally last year across the broader Madsen land package. Not only was Upper 8 a success, where we defined a new ore shoot at similar or the same orientation and geologic setting as 8 Zone Deep, but at much shallower levels, but we also had some very encouraging results from an area called North Shore, which sits about 1 kilometer northeast of the main Madsen deposit, right along the main mine trend. And what we intercepted there were broad 100-meter plus intercepts of Madsen style alteration with the same geochemical signature that we have at Madsen associated with gold in the same geologic setting, where we were hitting these zones of alteration adjacent to ultramafic bodies. So that was very encouraging to us. The gold values were sparse, but just seeing, the size of the alteration package we intercepted was enough to give us enough validation to go back and definitely follow up on those targets. So we could be seeing an extension of the main Madsen deposit 1 kilometer to the north.
Oh, wow. It's a great exploration roadmap. Thank you. Now, just moving back into a question on operations here. What is the timeline you've been telling investors for when you expect to reach your 800 tons per day processing target?
Yeah, we're shooting towards end of year to be ramped up to 800 tons per day. We're operating right now at around 650 tons per day as we continue to ramp up. And then by the end of the year, we should be at that 800 ton per day mark. At least that's our goal.
Okay, great. Now, so you have a great slide in your deck. I'm going to bring this up while you're talking about the impact higher gold prices have on the potential size of the Madsen deposit. Can you explain the upside potential shown in the chart for anyone watching?
Yeah, definitely. It's a very informative chart for sure, and that actually comes right out of our PFS study that we put out in January of this year. And so, really, what that shows is sort of a risk assessment, if you will, or upside case, really, where the PFS was based on a 1680 gold price, and so with that being said, it was very conservative. It resulted in a very selective, highly constrained mine model, which was built in a large part on cut and fill mining methods, which is very selective mining methods. And it also took the reserve and ended up with a reserve that was a little less than 500,000 ounces. And that's coming from a resource base that's 90% indicated, that's closer to 1.6 million ounces if we're talking about Madsen proper. And so that's quite the haircut, going from 1.6 million ounces down to just under 500,000 ounces. But a large reason for that was the conservative gold price used. If we tick that up and we get closer to a gold price that's being used pretty commonly now in recent PFS studies based on the rolling average of gold, say $2,400 an ounce there, as you see on that chart, our reserve, or not, shouldn't call it reserve, but our potentially mineable inventory could increase up closer to the ballpark of 1.2 million ounces. And a big reason for that is not only more of the resource gets integrated into the mine plan, but what we've also seen now is that more of the deposit is amenable to higher tonnage, lower cost, more efficient mining methods such as long hole stoping. And so we validated that as well through the bulk sampling process, where the entire bulk sample was mined via long hole stoping methods. So we know that works. We know that we can mine with that method in proximity to remnant workings and things of that effect. And so for us, that's tremendous upside. And we had a press release recently that sort of showed some of those bulk sample learnings, where overall tonnage and ounce profile within certain stope areas grew quite dramatically just by applying a higher gold price and then applying a mining method that was more conducive to a larger mining area. And so really what we're trying to do is decrease our mining costs and then get more ounces within a given area and taking advantage of the higher gold price.
And I know, because you guys have done so much definition drilling, does it make it easier, whether it's cost or less drill holes? If you had to increase that tonnage that you're able to produce at higher prices, you have to do less work because you just know more about the deposit than a typical mine might because of the history at Madsen?
Yeah, definitely. What the tight space drilling gives us is gives us that resolution and the confidence then to build our mine plan out on an inventory that we know is going to deliver. And so previously, the mine plan was actually built on the MRE model, which we do have in our PFS. But what we have the ability to do now is to take our tight space definition drilling, 6 to 8 meter, which is essentially stope drilling, and then build our mine plan out on that. So oftentimes, in the case of South Austin I mentioned before, where we start to intercept some of these, using the term bonanza grade intercepts, we get to get full value for that when we build it into a stope model. And so the tight space drilling even though it seems labor intensive, it's a necessary step. And we often get a lot of bang for our buck by going to that additional effort to drill this deposit out to the spacing that it really needs.
Okay. All right. Good. That's helpful to understand that. Now, just to end off our conversation, could you tell viewers what the key milestones are they should be looking for from West Red Lake over the coming year? You know, is it now cash flow, ultimately free cash flow? Like, what should we be watching here?
And well, maybe I'll just add one more question, just, prior to the catalyst. Maybe you could talk about just, obviously previous operator and, right now you guys are pouring gold, which is an exciting validation of everything you've done. Maybe you could just compare and contrast, just what, it's really a validation for, your roadmap and Shane and, and the entire team, but maybe just, thoughts there and then outlook.
Yeah, I mean, we're producing gold now. We're in a position where we have that, that inventory of high confidence ounces. We have a model that we know works. We had confidence in that model coming into this, but the bulk sample really, demonstrates that to the investors and our shareholders and the world really, so that people can understand, what this production profile might look like for the mine. So that performance is huge. Just being able to show it's like, the grades and the ounces that we said are going to be within these stope areas actually reconciled and went to the mill. And we got the gold out that we said we were going to get within a very fine degree of error, less than 5%. So that's major. And we had a lot of benefit too coming into this, right? And I think one of the biggest benefits we had was time. We had the ability to pick up this asset that needed a little bit of TLC to get it to a stage where it was ready to be restarted sustainably. And so we were able to do that over the course of 18 months. It started with the drilling. It rolled into, all of the capital projects that we put in place, the new camp, the raising of the tailings dam to get the capacity there to where it needed to be for a 6 to 7 year mine life at 800 tons per day. The connection drift from underground, which is a huge efficiency boost to our haulage abilities within the mine. All of those things, have gone into play in a very short amount of time to set us up for success. And so our confidence level is very high moving forward.
Great. And maybe you could just round things off with kind of key milestones that we should be watching over the next, say, year or so.
Yeah, absolutely. You nailed it on the head. So really for the remainder of this year is going to be the ramp up, right? So just demonstrating that we can sustainably ramp this mine up, get to our 800 tons per day and stay at 800 tons per day. And so we'll be delivering some performance metrics to the market later in the year as we kind of hit our stride, and we're excited to do so. We're also working on a PEA level study for Rowan, envisioning that as a direct ship scenario. So some of our investors remember Rowan. Some people may have forgotten about Rowan, but it's still there. It's a high grade satellite, deposit, also within the Red Lake district. 200,000 ounces at close to 13 grams of indicated resource, with an additional 100,000 ounces at around 8 grams, and a lot of expansion potential there. And so based on the resource that we currently have in the ground, we're shaping together a PEA right now. So we're excited to hopefully talk about that soon. So yeah, stay tuned for that as well.
Nice.
Will, thank you so much. Always a pleasure. And thanks for the phenomenal update, and congrats on all the success. That's Will Robinson, West Red Lake Gold. Thank you.
Thanks, guys. Appreciate it. Always a pleasure.
Thanks, Will. A hard money train keeps rolling, guys. Everyone, thank you so much. It's been a phenomenal day of great insights. Stay tuned. We got more Grizzle Hard Money.
Not stopping yet. Oh man, we did it! Hard money, baby. That's a wrap.
That was a wrap, man. That's
What a run,
another marathon in the books. I want to thank everyone who tuned into Hard Money across the YouTube, the Twitter, the X family. The X is obviously homestay. But yeah,
they showed up and we appreciate it.
Yeah, we really appreciate it. We had Hard Money's keep getting better. This was truly one of the best. We are living 2025 is a hard money year. And we got the macro specialists from Tracy to Bob to Chris Wood to Leigh Goehring to Jeroen, like the list goes on, and then a great set of corporates that right now the disconnect is here, where the commodities are priced here, and gold, silver, and then the equities are very cheap. And I'd be amiss to not mention James Seyffart as well. Fantastic insights about Bitcoin. That guy's like in the matrix of Bitcoin. But yeah,
I mean, tell me another conference that has the receipts like we do, where we've been following along with some of our guests, and they've been saying these things, and their hit rates are very, very high. It's great to just catch up, and you can, if you go back through and watch Bob's old interview, you can see how things have evolved and how he thinks about markets. Man, a lot of stuff to learn. So it's always a lot of fun for us.
It's been huge. Like, we are the only really standalone hard money conference that marries gold, silver, and Bitcoin. And that
why can't we all be friends, Tom? I know, what's the problem here?
I know. But but it's funny because like no one else marries them. We did this 3.5 years ago to say, listen, that this is how everyone should think about it, and we couldn't be more thrilled of the evolution of the conference, and more importantly, evolution of all the asset classes. It's just been a stellar run through that period. So thankful for everyone who's been an anchor for the conferences, which is getting stronger, just like the gold price, just like the Bitcoin price. Scott, what else? Where can they find us?
Oh, yeah. So I say, hopefully you guys enjoyed this. If you're just tuning into Grizzle for the first time, we put out a lot of research on different sectors. We do growth. We do hard money just like this. And so there's a few places you might want to find us. And if you want to read some of our old research, we have some stuff that has aged like fine wine.
Yeah.
So from a research perspective, on a weekly basis, our own Chris Wood, who you heard from earlier, he publishes on research.grizzle.com. So that's a place to find a lot of his very timely work. And then we also write the Bid Ask newsletter, which is ETF research that you're not going to find anywhere else, kind of breaking down what are the good ETFs out there, what are the bad ETFs, what are some risks in the products, looking at all the new ETFs that come out. So if you're someone who doesn't want to pick stocks and you just want to buy ETFs to build a portfolio, that's really your North Star. You're going to find a lot of value there. That is bid-ask.com. And then if you want to follow myself, I'm at ScottW_Grizzle on Twitter. And then what are you, Tom?
Yeah, Thomas G_Grizzle, and the masthead at Grizzle Media.
That's kind of where everything's going to come from too. If you want to follow us on Twitter.
Everything, and then also Bid Ask Research at Bid Ask Research. So guys, lots of places. Really want to. Also, I have to plug Pay Dirt Compass. It's a new Twitter, X Spaces that we're starting with Tracy Shuchart. We're gonna have a phenomenal, just insightful voyage of exploring companies and what they're doing. Their underlying commodities could be better priced. What we need to figure out, and the questions we're going to ask, is: are these the projects that you want exposure to? And we're going to build a repository of these companies, and I think we're going to add even like a voting feature, Scott, because this.
Yeah, that'll definitely come down the road.
So it'll be quite good. So guys, stay tuned for that. And short of that, I think, Scott, that's a wrap.
Yeah, let's put a bow on it. Thank you all for tuning in to Hard Money. We'll be back with another Hard Money next year, but before that, there's going to be many more conferences. So thank you so much for tuning in. Hard Money out.
Out.
it echoes in my mind.